Alrighty, so you are finally ready to look at our first entry model. So hopefully by now I've done a good enough job of drilling into your heads that this is almost the very last thing we look at when we are obviously on our charts. All of the hard work should already be done before you're even looking at your lower time frame. To take the entry. All of the work is done on building the high time frame and medium time frame narrative, understanding your multi-time frame analysis, identifying high probability POIs on your medium time frame to play that idea, and then only once price hits your medium time frame POI, the high probable one you're looking at, that's aligned with your directional bias, where there's enough risk reward on your side, everything's looking great, only then do you drop down to your lower time frame of choice, okay? And then look for the entry model. So for me, my medium time frame is the M15. So this black line here, I'm now drawing in red, represents your medium time frame. Okay, this is obviously then your medium time frame POI. So when it comes to the entry model, LC2A, the fake break entry model, the very first step is your medium time frame POI mitigation. Okay, so we do nothing until this happens. So literally set your alerts on your POI. And until that alert goes off, until we actually get price tapping into your POI, we do nothing. Only once we have the POI mitigation can we now look at the rest of the entry model requirements. Okay, so this is the primary and first entry model we're looking at. Now, I mean, you might be asking, what on earth is LC2A? Where did that come from? LC essentially just stands for liquidation candle. Not the most inventive name, but that will make sense in a minute. And the 2A, it comes from an old entry model that we used to trade and teach, which if you've been here a while, you'll definitely be familiar with. And that is regards to the fake break, okay? So if you're new and you're watching this for the first time, don't really worry about what 2A means. Just remember that this is the name, it's the fake break liquidation LC2A, okay? So again, step one, we must wait for our medium time frame POI mitigation. That's the probably most important step, because remember, the lower time frame entry model is simply a timing mechanism for our medium time frame POI. So if you trade, a super pretty looking entry model somewhere up here, but we haven't had a mitigation of our medium time frame POI yet, you're kind of pissing in the wind, right? Because price can do whatever it wants up here, but it's much more likely to want to mitigate this level before making that move that we're trying to capture, okay? So don't get roped into looking at the lower time frames until we have step one, okay? As soon as you have that, the question you now need to ask yourself is there a strong liquidation? Has a strong liquidation formed in the pullback? Okay, so once you get that mitigation on the medium time frame POI and you're looking at your lower time frame, you must then only look at the pullback, right? The medium time frame pullback to your POI, and somewhere within this green circle, so only in the pullback, you want to see, has there been a strong liquidation? Okay, so we're not looking at any strong lows in the leg here. This is not relevant for this entry model. I'm gonna keep saying it, we only look at what forms in the pullback, okay? And for a strong liquidation, because this is a bullish scenario where we want to get long, if you're a big guy and you're buying, what do you need? You need opposing sell side liquidity, right? You want to be getting long where there's lots of sell orders in the market, okay? And where do we assume there's going to be a lot of induced sell side liquidity? We assume it's going to be behind lows in the market, and to be more specific, strong lows. How do we define a strong low? A strong low is a low that broke structure. It's a low that caused a high, okay? So once we have our POI mitigation, we then look in the pullback and we go, has there been a strong liquidation? But what is that? We need to see a low that caused a high that has then been liquidated. So as we can see, price is coming down, okay? Price comes up. This low is not a strong low. Why? It did not break any structure to the left, right? It did not break the fractal high to the left, okay? So price comes down and it takes out that low, but that's not a strong low. So that's not a strong liquidation. Price comes up, it fails to break that high to the left. It doesn't cause a bullish chock. Okay, so when price comes down, that is not a strong liquidation because this is a weak low. It did not break any structure. Okay, so we follow it down. Now this low eventually breaks the fractal high on the lower time frame. Okay, so for me that would be the M5, and it causes a bullish lower time frame change of character. So now we have a strong low in the market. We have a low that broke a high to the left. Okay, it must be the true fractal high that it breaks. Okay, we're not looking at random highs within here. This is not relevant. We're looking at the fractal structure to the left. Okay, that eventually causes the choke. Now, this is another common mistake where people get wrong. Once we get the bullish shock here, okay, so imagine prices at this point in the market. The low that we care about for the strong liquidation is always the lowest low. Okay, so when we get the bullish change of character here, if you understand fractal structure, you will know that this is now where the fractal low is. Okay, that's the fractal low. So if price comes down, where I've drawn that red line, that is the bearish change of character. Okay, but we don't care about that for this entry model. What we are looking for is we want to see that bullish change of character. And as soon as that bullish change of character occurs here, we look for the lowest point that caused that change of character. Why? Because that's where the most amount of available strong liquidity is going to be. Okay, and that's what we care about. We want to see this lowest point that causes that break. We want to see that get liquidated. Okay, those are the rules for the strong liquidation. So it's the common mistakes that we see. One, make sure it breaks structure to the left. Okay, so this low eventually causes the true change of character here. It takes out the fractal high. Once that happens, we then find the lowest low. We always want the extreme. We want the most extreme bit of liquidity. So we'd mark it out. We draw our liquidation line on. Now we do nothing until that line is liquidated. If you see price doing this, it can chop around. It can go all the way up here. It can do whatever. It can take out all of these lows here. We're not interested. As soon as we get that first change of character here, we literally do nothing until that low is taken out. That's what we would be waiting for, okay? We don't care about anything that occurs here. We can get a bearish shock, we can get a bullish shock, we could then take out this low. Yes, that low has then caused the break of that high, but we don't care because we're waiting for the extreme low to go, okay? And this is a common mistake I see a lot. So always make sure that the lowest point here that you can see, that's what we're gonna wait for. So once we get that liquidation, assuming we have the POI mitigation, we then wait for the candle to close. Obviously, we'll get candles that come down. Once we have that liquidation candle in our POI, we then place our buy stop above it. Okay. Now, there's a few technical details on exactly how we do that, and I'll cover that in the next lesson when we go on the charts. Okay. But essentially, what we want to happen is the next candle pushes up and it will tag us into the trade. But if price keeps pushing down, we then cancel our order. We wait for the new candle to finish printing, and then we move our buy stop above here. Again, if price keeps pushing down, we cancel our order, and then once this new candle finishes printing, we'll place our buy stop here. So eventually, hopefully, we then get tagged in as price goes in our favor. However, if price keeps pushing down like this, cancel our order, and then eventually it breaks the POI, the very second that price trades through it, so it can be a wick break, this medium time frame POI has now failed, and the trade idea is finished. Okay, we are very strict with that rule with this entry model. As soon as price trades through the POI, a wick break is enough, okay, because it's supply and demand. If this POI is going to hold, there should be enough orders within price to contain price. There should be enough orders within the zone to contain price. So if price trades through, we are no longer looking for the entry model. We need to wait for a new medium time frame POI to form, okay? Now, yes, sometimes price can sweep the low and it can go, but that is not part of the rules for this entry model, okay? We're not doing that. So price must be within the POI. Okay, so in simple terms, wait for your medium time frame POI mitigation, identify if there has been a strong liquidation. If there hasn't been one, then what do? You simply wait, because sometimes price will be within the POI, then we get the fake break, identify the extreme low, wait for price to liquidate it. As long as we are still within the POI, now we can take the entry down here, okay? So the liquidation sometimes will happen before the POI, and sometimes it will happen within the POI. It doesn't matter where it happens. What does matter is that we must have the POI mitigation at some point, okay? So the reason why I put number 1 medium time frame POI mitigation is because that is the first thing that you must wait for. So that's why we do nothing until we actually get this mitigation. Then we look for the strong liquidation. Yes, this low led to the change of character there, right? The same way you'll map fractal structure, you should be comfortable with that. Once that change of character occurs, we always take the extreme, okay? And then we can take the entry, which will become clearer. Exactly how this will become clearer when we hop on the charts, okay? And you can go over that here. Mitigation of your medium time frame POI. Liquidation, So either find one if there has been one, in this case there has. If you get the mitigation and you can't see one, I can imagine price just comes down like this. There's no strong liquidation, then you wait. You simply wait. And what will happen is you'll usually get a bullish chock. Then you wait for this low to get liquidated, okay? And now we have the entry because we have the mitigation and the liquidation. Now, step 3, validation, we're not going to cover in this lesson. We'll cover that in a future lesson soon. But that's basically where sometimes you'll get like a liquidation all the way up here, right? Fake break, liquidated, and then price comes all the way down into your POI. And it's really like, well, is this liquidation relevant for here? And basically the validation lesson, which is coming up, that will help you answer that. Okay, we have 2 methods for that. You pick one, the PBL method or the early entry method. But don't worry about that for now. We'll get to that later. And then step 4, right? Once we've got all of this, we then place our stop order, so a buy stop above the entry candle, and then we hope that price will tag us in. Otherwise, if price keeps pushing down, then we keep cancelling our order and then place a new order once the candle finishes printing until eventually we get tagged in, or the POI fails and then the trade idea is over. Okay? But again, that'll become clearer in the next lesson. So the bearish case, exact same thing, but obviously bearish, right? This is your medium time frame. So you then have your medium time frame POI. You want to wait for a high probability POI where you have a clear directional bias. Okay, step 1, wait for your medium time frame POI mitigation. Step 2, look in the pullback, right? It must be in the pullback. We're not looking for any highs over here. That's not part of this entry model. That's not what we're interested in. We are only interested in what forms in the pullback. Okay. Has there been a strong liquidation? Well, let's look at the fractal structures. Higher highs, higher lows, higher highs. Then we do get a bearish shock here, right? This high breaks a low to the left, breaks the true fractal low. That causes a change of character. Where's our strong liquidation point? It's not this high. Yes, that's the fractal high, but that's not the one we care about. We always take the extreme. The highest point that caused the chock, that's where the most amount of available strong liquidity is going to be, where we want to be getting short. So again, if we get that change of character here, right, mark out your strong liquidation point, and then whatever price does, it can take this high, it can break a low, it can come back up again and take this high, it can do whatever. We don't care. We do nothing until that high goes, okay? Because sometimes this price action here can all occur within the POI, right? But it's the extreme high that must get liquidated. If we get that, then we enter on a liquidation candle, sell stop below the low, and we get tagged in, okay? So mitigation, strong liquidation, validation, you'll learn soon. And then, yeah, we'll place our stop orders above or below the candles, which will make more sense when we hop on the charts. So we're actually going to use an example that literally just happened yesterday. So for those of you guys who are watching this content just as we release this, I'm sure you will be familiar with this price action if you trade euro dollar. So very simply, the 4-hour swing structure is bullish. Okay, we have had a 4-hour break of structure, and we can clearly see that we're starting to have that 4-hour swing pullback, right? We've come into this 4-hour flip. It's quite a large zone. It's kind of more of a supply to demand range. Okay, we've tapped into it. If I actually go to these lines so we can see, I'll zoom in a little bit. When we tapped into that range, we then had a bullish change of character. So then it was looking like potentially, okay, the 4-hour swing pullback is finished, and now potentially we're ready to take out that swing high, right? That hasn't happened. We've kind of come up into around the top of the supply range, right? Had that mitigation, and then had a bit of a V-shaped sell-off and a change of character. So now the 4-hour chart in the short term is looking a little bit tricky to know what the directional bias is, right? Like, are we now probably going to have a deeper pullback, potentially into here or here before we go? Or are we just going to chop around and range a bit, right? 4-hour chart isn't looking super clear for like an intra session bias. That's kind of the point I'm trying to make here, okay? So that's fine. Let's jump down to the M15 and see if we can find a bit more clarity for a potential intraday trading opportunity. I'm just going to play forward the M15 price action a little bit nearer to pre-Frankfurt Open for our London session, okay? So, we can see here that the M15 initially switched bearish to facilitate that 4-hour swing pullback. Then this big gray box is that big 4-hour demand range I was talking about. So we know there's a possibility that the 4-hour swing pullback could end here, right? And then we would be targeting that next swing leg. The M15 then switched bullish, right? And we had 2 bullish bosses to the upside. So that was starting to look likely that we may take out that 4-hour swing high, but we mitigated this 4-hour supply range to the left, right? The big gray box area. And then we have sold off and we've switched bearish again. Okay, so the M15 swing is bearish, so that's signaling, that potentially we may be getting a deeper 4-hour swing pullback, or we may just be starting to range, right? This is a Friday, it's coming to the end of the week. We've kind of taken these lows down here. The immediate bias isn't super clear, but let's see, right? But the swing structure is bearish. So if we're looking coming into session, how can we potentially trade this? Well, right now there's nothing going on. This M15 low here has not broken any structure, right? It's just a weak low. For shorts, we want to wait for price to pull back up to one of these POIs, that value, so we can try and capture that swing lower high to see if we're going to get that next leg. And for longs, nothing going on, right? We don't want to be buying from a weak lows. So ideally for longs, you want to see at least a strong liquidation, and then you want to see structure shift in your favor, right? At minimum, like an M15 chock. That will give us a fresh POI, right? And then we can look for the trade. Or what would be even better is if we get that strong liquidation and then we see the internal structure clearly shift bullish, and then we can look to follow that internal structure to play the swing pullback, right, into supply. And then we could potentially look for shorts to go down, okay? If you're at this stage in the course and you haven't skipped ahead, hopefully all of this should be very somewhat familiar to you, because again, you're going to be sick of hearing me say this throughout this module, but I'm going to keep repeating it because it's important that this is drilled into your mind. Medium time frame, POI selection, building that medium time frame and hard time frame narrative is the single most important thing with this strategy. Okay, it's the most important thing. Once you have nailed that skill, the rest of it all falls into place with the entry model, okay? So at this point, just waiting for more development. Let's see what happens. So those lows get taken. Okay, then we start to get a bit of a liquidity sweep, as we can see, price grabbing the orders below these Asian session lows. We also have obviously these big equal lows to the left as well. So we've just taken a ton of sell side liquidity below here. And if I play a little bit more forward, we can now see that big V-shaped reaction, essentially giving us an internal bullish break of structure there to the upside. So we've had that sweep liquidity, internal structure starting to shift to the upside. Now there's decent probability that we can play the swing pullback for a quick move, potentially up towards this supply zone, right? Just a quick in and out move to play the swing pullback. And we have a very obvious level of demand to, a POI to look for potential longs from that led to that IBOS. Okay, so obviously we're just focusing on LC2A. We're going to look for that fake break liquidation on the M5. So now what you can do, if you're happy to trade this long idea and if you like this POI, is set your alert on the POI and wait for that to go off. So we're going to sit patiently and wait for it to go off. Not happened yet. Price is moving around. Now our alert goes off. So do you know what I'm going to do? I'm actually going to talk through the current, what you're used to. We're going to look at liquidity entry model 2A. The traditional fake break entry model that you should be familiar with, okay? So at this point, how would we trade that? Well, we have our POI mitigation. Step one, we know we need that to happen. That is a minimum criteria. Step two, do we have an active strong liquidation, right? This is for LQEM2A. Yes, we have had a fake break, okay? Price has come down, it's come up, it's come down, and then we've broken that high, right? So we have that change of character. Now, yes, for those of you who are being 100% true, at that moment, this is actually the fractal high, and that was the fractal low when we pull back. So this is technically what we call an eye chock, okay? But we use it with the entry model, right? When we get essentially that pro trend move where price is pulling back and breaks the high, we just want to see that this low here did actually break some structure, okay? So here we essentially have that M5 eye chock, if you want to call it. You want to be completely mechanical there. This low broke that high. So now we know we have the fake break. We take the extreme of that leg, and that is our strong liquidation. So you should all be very, very familiar with this. If you're not, please do not skip ahead to these lessons. Go back through the course. This needs to be you need to be very, very comfortable with that. Okay, so we have the low breaking the high. Now we have our strong liquidation. So for the the old entry model, LQEM2A, what is our next step? Our next step is to identify the PBL. This is the PBL that led to the break of the low. Okay. So what we would need to see is we would need to see that to fail, and we would need to see a change of character back in our favor, right? So there's quite a few steps for price to still form for us to look to get involved. So our POI is still respected, that's good, which means the trade idea is still valid. Now we have a V-shape, right? POI mitigation, V-shape, the PBL has now failed. That is our mechanical way of saying that potentially institutions have used the sell side liquidity below this strong low. They've used that to get long, and they've now regained control, right? Demand has regained control over supply because our PBL has failed and structure has shifted back in our favor. So now we have seen everything we need to see. There's no PBL flip. So now we can set our order on the extreme, right? This is liquidity entry model 2A. Of course, you can use the 25% rule to try and improve your risk to reward a little bit. But of course, increasing your risk to rewards can also increase the probability of us not getting tagged in, because price has to pull back even further, right, than the top of the zone to get us into the trade, right? So let's see what happens. We set our limit order. Price is pulling back. Do we get tagged in? No, we just get swerved. Price goes without us, and we would have to cancel our order. Sad face, right? The great thing about this entry model, like I said before, is it gives us tons of confirmation. It is very, very mechanical. And unfortunately, it's a bit over refined sometimes, and you don't get quite tagged in because, if you look at it, this is quite, if we look at the M15 for a second, it's quite a small range, right? It's just a little movement up, a few candles, price is coming back in. By the time we fill up those orders, if we're on the M5, what do we have to wait for? We have to wait for that full entry model to play out. And very often, it's not going to come back and tag us in. It's just a quick movement and then price is ready to go. You can see here with the M15 price action as well, right? We've taken that high, that creates new M15 demand, price fills up those orders and goes, right? So especially when you have tight price action like this, and then you're only dropping down to the M5, which isn't a very big gap, it can be a lot harder to then get enough price action to play out to then get you into the entry. So let's show the small tweak, but powerful impact that has to this whole scenario. So let's just bring it back a few candles. We don't need to go over the whole thing, right? Again, the first thing we need to do is the exact same step. We identify our POI, we've built our directional bias, and we're waiting for our alert to go off. Okay, our alert goes off, ding, 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 whatever. Oh, I don't know why I'm doing alert noises. Anyway, ignore that. So the strong liquidation is the next thing we look for. Has one occurred? Yes, we have a strong liquidation here, okay? Now, this is when we can start to look for an entry, but there's one other factor that I don't think I've mentioned that is important, and that is we do not want to see the PBL having already done its job, okay? So let me show you a quick example of what I mean. So if I draw, this would be your M15 POI, and this is the exact zone you'd be looking to trade from, okay? Now price on the M5 is pulling back into our zone. We're waiting for our alert to go off. Price then does the fake break or a potential fake break, right? Breaks this high. This is now a strong low. Price then liquidates the strong low. Okay, so now we have our strong liquidation. But we do not have our POI mitigation yet, so we cannot look for an entry, right? All we have is the strong liquidation at this moment. Price then pulls back up and it mitigates the PBL that liquidated the strong low, okay? Then if price holds that PBL and then it makes a lower low, so I'm going to define that with a candle body closure of the low, right? It makes a clear lower low. Then we can say that the PBL is held and it's done its job. So I'm just going to draw that on for the sake of clarity, right? So we get the M5 chock here. That creates a fake break low or a strong low because it's broken structure. We then get the strong liquidation of that low. We can then identify the PBL that liquidated that low. Okay, here it is. If price pulls back up and the PBL holds, then price comes down and it makes a candle body closure break of this low. Okay, we can say definitively that the PBL has held and it has done its job, and its job is to make a new low. So what that means is then when we get our POI mitigation and we're ready to now try and trade this POI, the next question we always ask ourselves is there a strong liquidation that is active, that's available? Well, yes, we had a strong liquidation, but it's no longer active for us, because if we're saying that institutions have used the sell side liquidity below this low, if we think they've used that to get long, we can't say that they have because they haven't caused the PBL to fail. In fact, supply has stayed in control and we've come lower and it caused a lower low, right? So when we get here, if we see that and we see the PBL has held, then we ignore it. This is no longer relevant for our entry and we need to see a new fake break form. If that happens down here, we get a new fake break, right? So this low here breaks this high and then it gets liquidated. So there's your liquidity. And price is still within the POI. The POI has to be respected. Then we can enter. Okay, so that's the key thing. Now, on the testing I've done, again, I'll talk about this in the upcoming video where I go through it. This very rarely happens, or at least it will more often than not give you the entry down here that you need. Okay, it's pretty rare that like the PBL in this way kind of did its job and then there was no trade. So you don't need to worry about that massively, but that's the current rule that I'm using, that if the PBL is held, I'm not going to get involved. That may change in the future, we'll see, but with the current requirements we have, that's the rule I am following, okay? Right, so coming back to here, we want to get long, Here's our M15 demand zone. Our alert goes off. We wait for our strong liquidation. We clearly have our fake break. There's our liquidation. So the very moment that we get that liquidation candle, right, and we've had our POI mitigation, what we need to wait for is for this entry candle or liquidation candle, I'm not sure what we're going to call it, but this exact candle that causes a liquidation, we need to wait for it to finish closing. So if you look at the bottom, this is the 9:25 candle. So if it's a 5-minute candle, we need to wait until 9:30 before we can place our order. At the very second this candle closes, we place a buy stop order. Okay, so up until now, we've been using buy limits. A buy limit is when you set the order, price is above it. So you set a buy limit, so that price comes in and takes you in. A buy stop is when price is below your order, when you set your buy order, and price takes you up into the trade, okay, if you don't know that. So we will set our buy stop order above this candle. Now, I would advise you set, at least whatever your spread is with your broker above the candle, so you have that room to make sure that the price actually breaks the candle to tag you in. But you'll need to look at that with your own testing and what your own broker spread is. Stop loss goes just behind the candle. Again, you will need to do this in your own testing and factor in your own broker spread with what you need to deal with. Let's for now just keep it simple and say a pip, but you'll need to do this with your own testing, okay? And I'll talk about this again in more detail when we get to the back testing. And for management, just for this, we're going to keep it simple, and we're always going to target 3R, let's just say 3.3 to factor, roughly in commissions, okay? Again, I'll talk about management at a later date, but we're just going to do fixed R, set and forget, 3.3, keep it nice and simple. No trailing to break even, okay? So get the strong liquidation, the candle closes, we set up buy stop loss below the low, make sure you have your buffers on either side, okay? And now we wait. So one of three things can happen. We either get tagged into the trade, okay, perfect, then we just follow our management strategy and we do nothing, or we get an inside bar, right, where the price does not break the high to tag us in and it doesn't break the low. If that happens, then we just leave our order on. Otherwise, the third thing can happen is price breaks the low of this entry candle. If that happens, the very, very second that happens, the very second that price trades down, we will immediately cancel our order, okay? We'll remove it and cancel our order. Okay, and then what we need to do if that happens is we need to wait for this candle to finish printing. And then as long as price is still within the POI, all right, this needs to be respected, then we will simply set our entry order on that new candle, okay? And again, if that candle breaks, we'll keep moving it down once the next candle finishes printing, only as long as this is still respected until we're either tagged in or the POI fails, okay? So that's what we do. So let's see what happens. Let's play this forward. Okay, so the very moment that candle breaks, we would cancel our order. We would wait for this candle to finish printing. Once it finishes printing, we can see it's still within the POI. So we set our new order, adjust your stop loss to however you need to do it, target, etc., etc. You need to resize it. So make sure you're using the plugins for MetaTrader, right, or whatever, to help you do that automatically. Now we get tagged into the trade. So now we follow our management rule, which, as I'm saying, is going to be fixed, set and forget, target 3R or net 3R, right? No trading to break even. And we either take a loss or a win, nothing to do. So we just pay it out. This is where we'd be trying to get tagged in on the LQ EM2A, right? As we know, we don't. And unfortunately, we hit a nice winner. So there we go. Bit of a longer video breaking it down, but I wanted to take it slowly and talk through all the small details in here because it can seem very simple, and it is, but I know some of you will miss some of the small details with regards to exactly how we cancel and replace those orders. Okay, we'll go through tons of examples. But yeah, so everything is the same. Literally everything is the same up until the entry model point. We simply wait for that fake break to occur, wait for the strong liquidation. As long as it's within the, we've had that POI mitigation, we set our entry order on the candle. If the candle goes lower, cancel our order, wait for the new candle to closure, and we keep doing that until we're either tagged in or this POI fails. If we get inside bars, then we just leave the order on. The only way we would cancel the order if we just had inside bars is if we come to the end of your session and your session has ended, and obviously you want to remove your order, okay? Pretty simple. We'll go through more examples. Actually, so let's have a look at the M15, right? We'll wrap up with this. So now we've played the objective. The objective was to play the swing pullback. We're coming into a POI that potentially we know that M15 swing lower high could form, or at a minimum, we may just get a phase B, internal pullback into here before potentially we get a deeper move. So let's see if we can potentially get a setup to play that play. Not necessarily the highest probable position in the world because you're trading phase B, which is against the internal trend. But let's see. So we have our POI mitigation. That's step one. Do we have a strong liquidation here? not yet, but this high has broken this low, right? So we have an M5 chock, so potentially that can be our fake break. So what do? We don't do that. We draw our liquidity point on the high, and then we would set our alert and just patiently wait and see if price takes out that high. Let's see. So we get a liquidation. I want a bit quickly. Obviously, you want to do this slowly with the back testing. And there we go, right? So the POI is being respected. We have a fake break. We have a liquidation, some nice equal highs there as well, but we only care about the fake break. So let me bring it back even one more candle, okay? Now here we have the liquidation. We have the POI mitigation. So technically, once this 1:50 p.m. candle closes, you technically could enter here, stop loss above the high. But obviously, do you want to enter here? You got to weigh that up, right? You got to try and target past the swing low. Are you going to get your target there? I personally say the risk reward isn't there, so I'm not really going to want to take that in this scenario. So I'm going to wait more. What happens? Price pushes up higher. Okay, we're still within the POI. We've got a much smaller candle, so now that's much more ideal. Okay, whatever your buffers are on the stop loss and the entry, right? Let's just say 6 pips. Again, we'll talk about this in the statistics video later on, and target, let's say 3.3R. Okay, so we either get tagged in, or if price breaks the high, I will cancel the order. Get tagged into the trade, so now we do nothing and just set and forget. Let's see what happens, and there we go. Okay, so you can see how powerful and effective this is. Now, every session is not going to be like this, where you just can trade both sides of the market and you get 2 winners in a row. Obviously, markets aren't always that nice, but this was a great example literally yesterday of just how it can play out. And for those of you who are experienced with Liquidity Entry Model 2A, you would have seen setting your order there, no tag. Then if you waited for this, you would get the PBL fail and shock here. Then you would have set your entry order on the extreme, right? Because there's no clear flip. Then you would have got another no tag, and then the move's done. And then it's the end of Friday, so you don't want to be looking for any more positions. Okay, this allows us to get in early, capitalize on the move, remove our risk before that trade's barely got going, and it's super, super powerful. But I will say the caveat is you were getting in with less confirmation, so you can get on the wrong side of the market a lot if you are not skilled and done the work and the patience in building the narrative and POI selection. So I'll leave you with that. Okay, so the next few lessons, we're going to go over a lot more examples. We're going to look at sort of low, medium, and high probability positions, and then we'll dig into the statistics and talk about backtesting. All right, so one of the very common mistakes with this is not using or not looking for the fake break liquidation in the correct area. Okay, so very simply, we are just looking for the liquidation to occur in the pullback that comes back to the POI. Okay, so once we get the initiation out of the range that then creates our POI, when price is coming back to our POI on our lower time frame of choice, i.e. the M5, we must see that fake break, that strong liquidation occur in this pullback to the POI. Okay, we are not using anything in the leg to the left. Okay, no lid, no highs or lows in the leg to the left. That is not relevant for this entry model. We ignore that. It must be built in the pullback to the POI. Okay, so very simply, price comes back. We get the potential fake break, right? This low becomes a strong low because it broke structure. Once that low is liquidated, if we then get our POI mitigation, we can then take the trade. Okay, this is where it has been built and taken in the pullback. This is a mistake I'm seeing quite often, and it's not valid for this specific entry model, okay? Why? Well, this is where the pullback starts from, right? Once we get the pullback here, it's just a straight movement down and a straight movement up. There is no liquidity built or taken in the pullback. The only strong liquidity that is taken, it's in the leg to the left, right? Denoted by this red area. This is the leg. This is the leg to the left. There is a strong low here, okay, and that has been liquidated, but that is not part of this entry model, okay? For LC2A, it must be in the pullback. We do not look at anything in the leg to the left, right? We do not use lid. We only use the stuff that's built in the pullback. So to give you a quick example here, right, this is the M15. Let's say we're looking for shorts from within here. There is, like, let's say M15 strong liquidity to the left, okay? This is a structural high. That is valid lid. But for this entry model, we are not looking at anything in this leg. This is all irrelevant for the LC2A entry model. We are only interested on what forms to the right in the pullback on our lower time frame of choice. So if we jump down to the M5, if this is our execution time frame from our M15 POI, okay, this we're not looking at, okay? We don't care about the liquidation of that. It's irrelevant. So there is no entry here. Okay, there's nothing on M5 because all we are looking at is for strong liquidity to be built and taken in this leg. But if we look, right, all of these candles break the previous candle's high, we get a pullback. That is not a strong liquidation because this high did not break any structure. This high here, right, when it pulled back, it didn't break any structure. So there's no strong liquidation and then price goes. Okay, so there is no valid LC2A entry here because there's nothing built in the pullback. For there to have been a valid entry here, we would have needed to have seen this. We would have needed to have seen this high, break this low. So at least we get some form of a break of structure. Okay, then we would look for the liquidation of that high. So you would want to see a bearish M5 change of character. Okay, so at least that high breaks some form of structure. That would then generate strong liquidity behind that high. Okay, we would look for that high to be taken. And then if it gives us our entry candle, that will tag us in with a sell stop, then that would be a valid entry. But that doesn't happen, right? We just get weak highs taken and it goes off. So there is no valid entry with these rules, okay? So make sure it's built in the pullback and you're not looking at highs or lows in the previous leg. Alrighty, so this is the sort of second version of this lesson. I posted a version of this lesson before, but it has led to a lot of common mistakes. So you need to really, really pay attention to this lesson because if you use what we're about to go through in the incorrect way, you are going to end up taking so many invalid and low probability trades. So this is extremely, extremely crucial that you get this correct and you know exactly how to use this method when it is valid. Okay, so this is super important that you get this lesson correct, but let's go through it. So as you have seen so far with this entry model, the LC2A, we are very simply looking for a fake break liquidation to occur where we have a low that breaks the high. We look for that to get liquidated. And if it is with our POI mitigation, we take the entry. Okay, so we are not looking at any liquidity points as we saw in the previous lesson, right? We're not looking at anything in the leg to the left in this swing leg here, right? The leg inducement. If there's any lower time frame lows within here or anything when you look down or medium time frame, we don't care about anything in here, right? That should be very clear from the previous lesson. We only care about what forms in the pullback for when we are looking for potential strong liquidations to trade this POI, okay? We should all be very, very clear on that. So when you are looking at your lower time frame, typically what you will see is there would have been a bearish chalk up here, right? And then we have all of this price action here. And once we finally get our POI mitigation, right, at this point here, as soon as price hits your POI, what do we look for? We look to see if a strong liquidation has already occurred. In this case, we can see that, right? Because back here, we had bearish fractal structure on the lower time frame. Price then broke the high, so we got a bullish change of character. Okay, we then mark the extreme low that caused that chalk. We always take the lowest point that led to that. Okay, nothing here. We always want to take the lowest point. That then gets liquidated. And now that we have that combined with our POI mitigation, now we can take the trade, okay? So it doesn't matter that the liquidation occurs before the POI, right? It can occur within the POI. It can occur before it. It doesn't matter. Just as long as we only take the trade once the POI has been mitigated. Yep. If we get the POI mitigation at this point and there hasn't been a strong liquidation yet, then what do? We simply wait for one to occur within the POI, okay? And then we can take the entry if it's still within the POI. They are the basics. They are what you should be very, very comfortable with at this point. So this is how a typical textbook entry looks like. It's very easy to see the textbook entries. The immediate, it occurs in the immediate price action right in front or within the POI. We get a nice clean fake break, liquidation, mitigation, and then we basically trade that move, okay? These are the simple trades. That is how the majority, 90% of your trades should look like this, okay? But what we're going to go through today in this lesson is when there's a slight difference, but it's a rare circumstance, okay? Let's go through it. So there's a lot going on here when you first look at it, and we're going to go through it really, really slowly because it is super key that you get this, okay? So what this method is when we can use iChalks for our fake break. So an iChalk is when you are looking at the internal fractal structure. So internal fractal structure is the fractal structure that occurs between the true fractal high and low. Okay, so it's extremely, extremely, extremely important that you are only using this method when, well, let me show you exactly when, but basically it is when the true fractal low is behind or within the POI. Okay, so let me go through it really slowly and it will become very, very clear. Some of you may think you have this, but I'm seeing a ridiculous amount of people getting this wrong in the Discord so far, okay? So please listen to this very, very, very carefully. So sometimes, and this won't happen a lot, let me just draw on these lines, I've forgotten it. Sometimes you will get kind of quite like a small medium time frame range where you always get like an impulsive leg like this, right, on your medium time frame. And then this will obviously give us the POI that we then potentially want to trade from. But when we drop down to our lower time frame, so this is the thin gray price action, what you may notice is when you go to map your lower time frame fractal structure, because this was one impulsive leg on your lower time frame as well, you may find that when you go to find the fractal high and the fractal low, that actually it's all the way down here still. Because when you look at these candles on your lower time frame, they might all have broken the previous candle's high. And what does that mean? Well, it means that if you're trying to find where the fractal low is on the lower time frame, it's actually all the way down here still, right? Because that was the last fractal low, and then this is all just one fractal leg. There's no fractal low within here, okay? So if this is where that true active fractal low is on your lower time frame, well, for us to use the LC2A entry model, where we need a fake break to occur, right, for a fractal high to be broken, well, how can we do that? Because the fractal high is up here and the fractal low is down here. So that means any price action that then forms within here, that would mean that we can't trade it. We'd have to ignore it. But obviously, that's not ideal, because if we get something like this, where we get a low that leads to a break of a high, and then we get a liquidation of that low, I personally want to use that. That's good enough for me. I want to get involved. But technically, it wouldn't be valid because the true fractal low is all the way down here and the fractal high is up here. So you would need to wait for the high or low to be broken for there to be a chalk. Okay? So again, this is super, super key. You only now look at the internal fractal structure only in this scenario where the true low is behind or within the POI. Okay? Because what I'm seeing people are now doing is they're using the internal structure when that isn't the case. Okay, so we only do it when we get like a really impulsive leg down here and the true low and high are basically on this leg, and this is your internal fractal structure. So the way you do this, okay, when this happens and you see that the true low is behind or within the POI, so by within the POI, what I mean is sometimes like the fractal low might be like here, right? So then when price comes back and you get your POI mitigation, okay, well, it hasn't actually taken the true fractal low yet. So this is when, we're at this point, you're allowed to look at the internal fractal structure, okay? So once you've identified that the true fractal low is, behind the POI or like within it, like say somewhere down here, but price action is here, you're then allowed to consider the internal fractal structure, okay? But this is the next super, super key point that a lot of people are getting wrong. The way you map your internal fractal structure is you start mapping it from the very start of the pullback up here, okay? So you need to make sure that if the true fractal low is like all the way down here and you're going to use the internal structure, start mapping it literally from the start of the pullback up here, okay? So you'll see that this is the true internal fractal low, right? Then that's the internal fractal high, and you look at these points here, okay? So where I put the orange circles on, those are the internal fractal highs and lows, okay? Because you start mapping it from here. So that's the first low, right? So then you can start mapping it from here, right? That's then that fractal bearish continuation, which means this is our new fractal high. Okay, so at that moment, that's our internal fractal high. Price is coming down, then we pull back. So at this point, this is our internal fractal low. Price then breaks it, okay? So if we get rid of all these lines, that's our next internal fractal break to the downside, okay? So at this point, that's our internal fractal high, right? And this is our internal fractal low. Okay, when price is here. Price is then pulling back. All of this price action within here, okay, where is it? It is between the internal fractal high and it's between the internal fractal low, okay? Because this, remember, is the true fractal low. So that up until now, this is always what you've paid attention to. This is the true internal fractal low. This is the true internal fractal high. Why? Because there were no fractal pullbacks within here. So all of this price action that we're looking at with the orange dots, this is the internal fractal structure, right? You start mapping it from the start of the pullback. Internal fractal low, we get a break, that becomes our internal fractal high, we get a pullback, we get a break. So right now when price is here, this is our bearish internal fractal range, right? That's the internal fractal high, this is the internal fractal low. So all of this price action here, what is this? This is in between the internal fractal high and the internal fractal low. So what would we call this? We would call this the internal of the internal fractal structure, right? It gets a bit confusing. We always ignore this price action, okay? So we only ever go to one layer of internal fractal structure. We never go to that second layer. We are never mapping or caring about the internal of the internal fractal structure, okay? This is the fractal high, this is the fractal low. At this point, this is the internal fractal high and the internal fractal low. We ignore the price action between that. We ignore the internal of the internal, okay? That is not relevant for what we're looking at or what we need. That is super, super key, okay? So start mapping it from here. We pull back, right? This is bearish internal fractal structure. That internal high at this point then gets broken, okay? So we get a move that leads to a break of that high. So at that moment, we now have a potential fake break of the internal fractal structure. We get an ICHOC, an internal change of character, right? Because the internal high is broken. We ignore the internal of the internal. We're only looking at that first layer of internal structure, okay? Now this is the third bit that a lot of people are getting wrong. Once we get that internal structure and we get that fake break, right? This potential fake break, where do we put our strong liquidation point? It is not here, okay, because this is the internal fractal low at this point, right? Because that's the nearest low that took out the high, okay? But that is not what we care about for the actual strong liquidation point. For the strong liquidation point, we always take the extreme point that led to the CHOC, to the break, okay? Because we want to take the lowest point. We want to take the best area where there's going to be the strongest liquidity, and that's always going to be the lowest point, okay? So again, when we have an impulsive leg like this and we look on our lower time frame and the lower time frame true fractal low is all the way down here or somewhere within the POI, right? That is then when we are allowed to consider the first layer of internal structure. But where do we map it? We start mapping it from the very, very start of the pullback. We then start mapping where those internal fractal highs and lows are. So we start mapping it here where I'm drawing it in red. We start mapping it here, right? Lower low, internal lower high, internal lower low. So at that point, these two red lines are the internal fractal range, right? So all of the price action between those two red lines, between the internal fractal high here and the internal fractal low, we ignore all of these highs and lows, okay? At this point here, the internal fractal high is broken. So now what we can do is we can label that bullish internal change of character, okay? So we have our internal change of character, which means we now have our first internal potential fake break, right? So to find the strong liquidation point, we don't take the new internal fractal low, because this would be it. Instead, we map the extreme internal low that led to that break. We always take the lowest point because that is where the strongest amount of liquidity will be. We don't care about any of these lows for the strong liquidation point. So the very, very moment you get that internal change of character to the upside on the first layer of internal structure, draw this line with the X or whatever you use and set your alert there, okay? The moment that this happens here, we get the fake break, look for the lowest point, draw your line there, set your alert, and you now ignore everything that happens until this extreme low is broken, okay? So once this happens and you set your alert there, price can do this, it can do this, it can come down, it can sweep these lows, it can go back up, it can break more highs, it can do all of this. We don't care. We are waiting for this very, very extreme low to be broken. Only once it's broken, then we can look to potentially get involved. Okay? So that's super, super key. Only map the first layer of internal structure. You do that by looking at the very first highs and lows that form within the pullback. You then wait for that internal high to be broken. The moment that breaks, you find the extreme low, which is here, okay? You ignore the true internal fractal low at that point. You're looking for the extreme liquidation point. You ignore everything that happened. If price comes down like this, I'm gonna draw it, hang on, okay? And breaks this low, that is actually a bearish internal change of character, because that's the first layer of internal structure still, because this is the low that broke that high. It's the nearest internal low. But because we've already had that first fake break here, okay, we're now not caring about that, and we're waiting for the extreme liquidation point to occur. So if this happens, that's not a valid trade. We ignore everything that happens here. I don't care what happens here. The extreme point must go. Okay, I'm going to keep repeating this because I'm seeing so many mistakes with it. Okay, so this is valid. If it gets liquidated, the POI is still respected, we can take the entry. Okay. So read these annotations. It can kind of help you to do it, right? Map the extreme low that broke the internal fractal high. We've done that. Okay, this low here. We always take the extreme high and low that caused that break. Okay, so yes, this low here did break this high, but why do we not care about that? Because that's the internal of the internal fractal structure. We don't care about it. We only map the first layer, and we define that from the start of the pullback. Okay, once that fake break occurs, we take the extreme, and you wait for that to go. Now, the only reason, again, people keep forgetting this, and it's okay, but you need to get this drilled into your mind. The only reason why we are allowed to look at the internal fractal structure is because of point 1. So do not forget this point. This is why it's step 1. We only look at the internal fractal structure when the true fractal low is too far away, right? So it's all the way behind the POI. So it doesn't allow us to get involved in this position if this happens unless we can look at the internal structure, the first layer. So that's why step 1 is super, super key. We never ever even think about mapping the internal structure unless step 1 has happened. And it doesn't happen that often. It's quite rare that it happens. So this is almost like an exception. This is a rare circumstance. Your brain should just literally just be thinking about mapping the true fractal structure 98% of times. This is in the rare occasion where you kind of get like a small and medium time frame range. Maybe it's quite impulsive. You drop down to lower time frame and the true fractal low is like here or here. So then when we get the mitigation, you know, well, I need to work with this price action. And this is then when you can use this method. But it's a rare thing. So if you don't understand this and you find it confusing, it's absolutely fine. Ignore this. Maybe come back to it at a later date, and just always ignore the internal price action for you, because it's not going to be the difference between you being profitable or not. This is quite rare. Okay, I don't know the exact numbers of how often it happens, but it is very, very rare. Okay, so make sure you have these rules in your mind. It's super, super important that you get each of these steps correct. Okay, map it from the start of the pullback. Only use the first layer, and only use this entire method if the fractal low is like all the way down here or down here, right? So yeah, okay. So what are the ways in which it can be invalid and what I'm seeing? Well, again, step 1, it's the same scenario. Let me just put this on. Okay, exact same scenario where the true fractal low is all the way down here, or say somewhere within the POI. Okay, so this is when you are then allowed to go to step 2, which is pay attention to the internal structure. Where do you start mapping it? You start mapping it from the very start of the pullback. Don't just suddenly look at the price action here and go, well, this looks like the internal fractal. No, because you could be wrong. You need to go all the way back up to here, okay? So start mapping it from here, then you'll have the true range, okay? So when we get this fractal break here, right, where is our internal fractal range? This would be the internal fractal high, and this is your internal fractal low. So if price does this, and we come up and we come up, and then we come down at this point, so when price action is here, let me zoom right in. Okay, what I'm seeing is people are looking at this. Okay, imagine we've already got the mitigation, right? So to make it a bit more valid, price action is here, and they're going, well, this low broke this high, so therefore it must be a strong low because it broke a high to the left. We've got the liquidation, we're within the POI. Now I'm going to take the trade. Invalid. Why is it invalid? Because this low here broke the internal of the internal. It's not valid. Right, sorry. Like, this is the range we're within. That's why it's super important you know where the first layer of internal structure is. This is the first layer. This is the internal low. This is the internal high. We ignore everything in between. So if price comes down and liquidates this low, yes, this low here broke this high, but that's the internal of the internal. It is irrelevant. It is invalid. It is not strong enough. We do not care about it. Okay? Now, if price comes down and liquidates this low, this is the true internal fractal low, right? This is that first layer of internal structure. This is the internal fractal low. So if we get a liquidation of this into our POI, why is that not valid? Because it is the true internal fractal low. It's the first layer of internal structure. Well, is this a strong low? Did it break any structure to the left? No, it didn't do that, right? This is the true internal fractal low. It needs to break the internal fractal high. It didn't do that. For this low to be valid, it would need to break this high, then we take the extreme low, then we get it liquidated, but it didn't do that, okay? So first layer of internal structure, you map that from the start of the pullback. This is the true low, but this low must break the true internal fractal high to the left, which it didn't do. So we ignore all of this. This is all internal of the internal. We don't care about it. It's not significant. So when price comes and liquidates this, this is the true internal low, but it didn't break the high to the left. Therefore, it's invalid. Okay, so neither of those liquidations are valid. Okay? If you find this confusing, it's fine. Just don't even think about internal fractal structure. Literally leave it. It will not make a massive difference to your results. But if you start using this wrong, it will have a huge, probably negative impact on your results. Okay? Because you're going to be there'll be trades everywhere. There's almost no situation in which an internal fractal structure isn't going to happen. Like these liquidations are going to be everywhere, and you're going to be trading all sorts of madness, and there's going to be like a million valid trades a day. Okay? So again, this scenario is quite rare. Make sure you're mapping it from the start of the pullback, and make sure when you get the true fake break of that first layer of internal structure, you always take the extreme point. So if we're getting long, we always take the lowest point that led to that break. And if we're getting short, you'd always take the highest point. Okay? Watch this again and again and again, and we'll look at one example. So this is an example from, I think, pretty much the first lesson in this module. Let's not worry about the overall trade idea, but essentially we want to trade from this M15 POI. Okay, so this is our medium time frame on the M15. This is the zone we want to look to get long from. Let's jump down to our lower time frame, which is going to be the M5 in this case. Okay, now when you jump down to the M5, where is the true fractal low? Well, if we look here, that was the last fractal pullback, and then all of these candles break the previous candle's high. Okay, so that means the true fractal low is all the way down here. Okay, so remember, with this setup, we're only looking for strong liquidity points that form in the pullback, right? We're not looking at any liquidity points here. It must be in the pullback, right? Pullback inducement, okay? So if we know that, and what then happens if price comes down like this, gives a fake break, right? Like this, and then we go to the low here, and then we come down, right? Can we take that trade? Well, the true fractal low is down here, and the true fractal high is all the way up here. So if you don't use internal fractal structure, this would not be valid for you, because you would need to wait for either this, this low to go or the high to go for a new fractal structure. This is all the internal, okay? So that is why we use internal fractal structure only in these scenarios, because otherwise you're going to have to sit on your hands. So that's why I'm happy to use internal fractal structure only when the true low is within or behind the POI, okay? So that's step one. This is why then I'm even beginning to think about using the internal structure, right? Because the low is down here. So now I'm going to map the first layer of internal structure in the pullback, okay? So let's see what happens, right? So we're starting to pull back, okay? Don't really have anything to work with to map, okay? Now we can see our first internal fractal low, right? So, let's draw that on, okay? And you can view that as your first internal low, okay? Because the true internal low is obviously down here. This is the pullback. We've had a movement up. So this is our first layer of internal fractal structure, okay? Internal fractal structure. Price then has a fractal continuation, fine, okay? So then this would be our internal fractal low, and this will be our internal fractal high, okay? So basically we just have bearish internal fractal structure. That's fine, okay? So what would we need to see for a fake break? Well, we need to see the internal fractal high get broken, okay? So if price comes up and breaks that internal fractal high, the first layer, this then will be the extreme point that led to that bullish internal chock, that bullish I chock, which then means this would be then the extreme low, the lowest point that we can then look to see get liquidated into our POI, and then we could take the entry if that happens, right? So this is where you can map your I chock if you want to use it, okay? Price pulls back. So now we get our bullish I chock, okay? Because remember, the true fractal low is down here, but we're allowed to map that first layer of internal fractal structure. So we now get that I chock. I'm just going to make it a solid line just so we can see it a bit more. There we go. So now that happens, okay? This is key. Take the extreme. Now it's obvious in this scenario because it's just kind of one leg, but sometimes it can be a bit more complex, and you can see like price comes up and it forms a low like this, and then we get the bullish internal chock, the I chock, and then yes, this is then the actual internal fractal low at that point. That would be the correct internal fractal low, but we don't care about that because what we're looking to do, once we get that I chock, We don't care where the new internal fractal low is. What we care about is where the strong liquidity point is. And that's always the lowest point that led to that movement. So it's obvious in this scenario, our eyes just go to here. But in more examples where there's like bigger price action, you need to be careful with that because I'm seeing that common mistake. So now we get the lowest point, and this is our strong liquidity point, okay? So now what you want to do is label that and set your alert if you use alerts, and you do nothing, okay, until this low is broken. Literally nothing. We want to see this get liquidated into our POI, okay? I know it seems super simple, but I'm just seeing so many mistakes with this. So it's super key you get it. So we do nothing, we do nothing. Now we get our liquidation. So now here's our fake break. We have our POI mitigation. We set our buy stop above the candle's high and below the low, and we do, whatever your management is, okay? As soon as that candle breaks the previous candle's low, you cancel your order and you wait for this new candle to finish printing. The very second this candle has finished printing, you have your buy stop above the high, stop loss buffer, whatever you're using below the low, and then your management, okay? Then you get tagged into the trade, and that's the trade, okay? So I know it can seem simple when you just see a nice example like this, but when there's all sorts of bigger and complex price action, a lot of you are applying the rules in the wrong way and using internal iChalks and using the internal of the internal fractal structure, and you're doing all of this madness when it's not valid, okay? So let me kind of show you in this example how it could have been invalid, and then we'll wrap it up. So at this point, you've, let's say, correctly identified step one, which is that you're only paying attention to the internal fractal structure because the true fractal low is within or behind the POI. So if we get a mitigation here, we want to use something that's formed in the pullback here, okay? So you recognize that. So step one means you're already mapping the internal structure from where? From the start of the pullback. You can recognize that we have the bearish internal fractal structure here. So at this point, this is the internal fractal low. This is the internal fractal high. You recognize that. So now you know you need to wait for a bullish iChalk to occur, okay? So we would wait for this high to go. And at that point, what do? We take the lowest point, okay? So if price comes up like this, get rid of that circle. If we get an up movement, a down movement, and then a bullish internal chalk here, an iChalk, okay? At this point here, where is the internal fractal low? It's here, okay? Because that would be the last candle that failed to break the previous candle's high. That would be the internal fractal low. But we don't care about that because as soon as we get that fake break that's near our POI, we take the lowest point, okay? We know that bit. So what is the ways in which people get confused is they'll know their internal fractal high is up here, right? And they should be waiting for the fake break, but price action will do something like this. It will come up, it will come down, okay? It will come up, and then it will come down like that. And then they're either trading this liquidation here, which is not valid. Why is it not valid? Because this extreme low did not break the first layer of internal fractal structure. It didn't break this high, okay? We don't care about this break. This is not valid because this is the internal of the internal fractal structure. So that's not a valid liquidation. This also is not a valid liquidation. Why? Because it's still, yes, this low did break a high. This low led to a break of the high to the left, but that's in the internal of the internal, so it is not relevant, okay? We only look at the first layer. And yeah, that's basically, I can't think of any more ways to kind of make this clear. So if you're finding this confusing, if it's melting your brain a little bit, just completely ignore the internal fractal structure. Never look at it. You do not need it. It will not be the difference between you being profitable or not over a large sample size. But if you are going to use it, you need to make sure you understand this inside out, because otherwise you'll end up taking trades, all sorts of invalid trades that are not valid. Okay? So it's a bit of a pedantic lesson where I have to really say the basics again and again and again, but it's to make sure that there are kind of no room for kind of, misinterpretation or error. So I've tried to think of every other way that this could kind of be misinterpreted. Hopefully I've kind of covered all bases now. I'll just leave it with that. If you find it confusing, leave it alone. Never look at the internal fractal structure. Just pay attention to the first, the true fractal structure. Otherwise, if you want to use it and you get it, okay, but just be careful with it, okay? Because obviously this is, in theory, lower probable than the true fractal structure. That's why we only use it in very specific scenarios. Alrighty, so this is another common mistake that can seem quite a simple one, but I'm seeing it a fair few times now. So Essentially, when we are looking at these fake break liquidations, it's the same rule we have always used, but we're always looking at the extreme high that leads to the break of structure for the liquidation. Okay, so let's go over the invalid example first. This is our medium time frame POI. We then drop down to the lower time frames when we get our medium time frame POI mitigation, and we look to see, is there a fake break, right? So we have this bullish fractal structure coming into our POI mitigation. Price then comes down, and then we get the bearish change of character, right? This is the bearish change of character line. We all know that. Now, at that point when price is here, where is the fractal high? Well, the fractal high will be the last candle that failed to break the previous candle's low, and that will be here, okay? So yeah, when price is here, this is the fractal high, okay? But when it comes to looking for these strong liquidations with this entry model, the way we have always done it is we don't take the fractal high, we take the extreme high that led to that break of structure, whether it's an IBOS, a CHOC, whatever. In terms of strong liquidity, we always take the extreme high that broke that low to the left, okay? We're not interested in anything within here. So basically when this shock happens here and price is down here, this is when we'll mark out our liquidity point on this line, set your alerts or whatever, and we wait for that to go. Okay, until this extreme high goes, we don't do anything. Okay, even if price just starts doing this and trending down, takes these highs, whatever, we're not interested. It needs to be this extreme high that goes. Okay, so like if this started coming down here, whatever, and all this, we're not interested. We need to wait for the extreme high. So this is the valid example to the right. Okay, exact same thing. We come up, we eventually get that bearish change of character, so we mark out the extreme high. That is the point we want to see go. I'm not interested in anything that occurs within here, okay? And that's it. I can't really explain too much else, but I'll go through a quick example. So let's just say this is our medium time frame POI mitigation. We get our mitigation and we get a bullish change of character here, okay? So now this is a low, right, that led to the break of that high after we got our mitigation. So potentially this could be a fake break that we are interested in trading from, right? So we'd set our alerts on this low and we would wait for it to go. Price doesn't pull back and it keeps pushing up. Now this low here, right, broke that high. So some people, I guess, are looking at this and going, well, that's a strong low. It led to a break. So if price now comes down to here, right, and they get the liquidation, they're now looking at this as an entry, okay? But that is not valid. I know this is a bullish example and the diagrams are bearish, but hopefully you can see in your mind, if you flip it, that we need to take the extreme high, which is this high. We are not interested if price comes up and just takes this high like this, okay? That is not valid. So this is why I'm saying once you get that initial fake break, literally draw the extreme low, set your alert, and you do nothing until this low is gone. Or of course, if price just goes away or whatever, and we get a break, then okay, this trade idea is no longer valid. You need to go back to your medium time frame. There'll likely be a new POI over here on your medium time frame, and then you would wait for the same thing to occur back over here, right? New price action, new fake break liquidation, etc. Okay, so that's why when you get the initial POI mitigation, you get that fake break, mark the extreme low that led to that break. Okay, if there was like a low here that caused the chalk up here, right? That's the true fractal low. We don't mark that. We mark the extreme low that led to that break. Okay, the lowest point that led to that break. That is what we care about for the extreme liquidation. We always want to be at the lowest point here for longs. So as price comes back at this point here, okay, I don't want to see any of you taking that as a strong liquidation. Yes, it's a low that broke that high, but it's not the extreme. Okay. So wait for this low to go. If it goes, there we go. So this point here, you set your entry order, buy stop above the high, right? And then whatever your stop loss buffer is, etc., etc. And then we're tagged into the trade, okay? So that's the difference. I know it can seem quite simple. Maybe it's a bit clearer with this price action, but some price action, maybe it's a little bit more tricky. But in your mind, you need to always say to yourself that you are taking, or even though we're looking at fractal structure for the fake break, it's the actual extreme high or low that we use then for the strong liquidity point. Alrighty, so one of the sorts of questions we had ourselves when we were developing this entry model and when we were testing was, how do you determine if the fake break, if that strong liquidation has occurred too far away from the POI. In other words, once we actually get our POI mitigation and we're looking to take the trade, and then we look left to see if a strong liquidation has already occurred, well, if we can see that one has occurred up here and it's quite a far distance away, is that still really relevant to taking the trade, right? And it brings in some subjectivity potentially to your decision making. So, let me use this opportunity as well just to clarify another rule, because I've had some questions around this. Step one is always wait for the POI mitigation, right? I think we all understand that. You have to wait for this to happen. Then what we do is we look to, as soon as that POI mitigation occurs, we then look to see, has there already been a strong liquidation that we can use? If we look within this entire pullback at that point, right, once we get the mitigation, if we look left to the pullback, because this is the only area within the pullback that we care about, right, for the strong liquidation to occur. So if we look left within here and we don't see any strong liquidation, there's no fake break, then obviously we just wait for one to form here within the POI. If it forms, we take the trade. If it doesn't, then we don't, okay? But once we get that mitigation here and we do look within the pullback and we can see one, and then our question is, well, is this still relevant? How do we determine that? And the answer to that is whether or not the PBL is still active, whether or not it has done its job, okay? So again, once you get your mitigation, the strong liquidation can occur within the POI, it can occur before it just still needs to be active. So how do we determine that? And very similar to what you guys would have learned in the previous modules, it all comes down to the PBL, okay? So let's look at an invalid case first. For those of you who have skipped ahead the lessons and you're not sure what PBL is, it stands for the point before the liquidation, okay? So when we get the strong liquidation occur, so the price pulls back, this low then breaks a high, so we have somewhat of a strong low, so we know that there's strong liquidity behind that low, so we draw on our liquidation line. When that line gets liquidated, when our strong low gets taken out, we can identify the PBL. That is the point before the liquidation. So if we liquidate a strong low, we identify the nearest supply zone that took out the low, okay? So the PBL is the nearest supply or demand zone that causes the strong liquidation, and it must not have been mitigated. Well, I'll get into that bit. So once we've identified the PBL, the supply that liquidated the low, okay, that would be this orange box. If price comes down, pulls back into that supply zone, pulls back into the PBL to mitigate it, and then the PBL holds, so price doesn't trade through it, the supply zone is respected, and then that supply zone leads to another move that breaks that low, right? It causes a lower low. So basically, that's when we say the PBL is held and the PBL has done its job because supply is held and it's caused a new low. If that happens, that means that we are no longer interested in this strong liquidation. Okay, that is the mechanical way, a mechanical rule that you can use to solve that problem of asking, is the strong liquidation occurred still relevant for the move that we are trying to trade from this POI? Okay, because obviously step one is wait for the POI mitigation, so that will be here. At this very moment, we then look left and we ask ourselves, has there been a strong liquidation? Well, in this example, there has been, because this low broke that high, therefore it's a strong low. That low was then liquidated. So when we get the mitigation here and we look left, yes, there has been a strong liquidation. But then the second question is that strong liquidation still valid? Do we still have like that active strong liquidation for us? And the way we determine that is we go, right, where is the PBL? Here it is. This is the supply that liquidated that low. And is it still active? Well, no, because price pulled back into it. It filled up those orders, supply held, and it made a new low. That's how we determine if the PBL done its job, is we want to see it make a lower low with a candle closure, okay? Because, especially if you're new, right, there's all these little intricate rules to try and keep track of, and it can be hard to remember. So the key with remembering things is trying to understand what the logic is behind them. The idea and the theory behind this, right, is why are we trying to identify strong liquidity, strong liquidations? Well, the idea is that if a low breaks a high, then we can, in theory, there should be more liquidity induced below that low, right? To induce more orders below that low. Why we want to see this in front of our POI or within our POI is because if we think big orders, the big guys, the big institutions are wanting to buy from here and get long, what do they need? They need opposing liquidity to enter the market with minimal slippage. In other words, if you're going to be entering with a ton of buy orders around this level, you need a lot of people selling to you at this level in order to get into the market at the price level that you want with minimal slippage. So that's why if we're looking to get long, we wait for that sell side liquidity to be induced below these strong lows, okay? Because that can increase the probability that this demand zone is going to hold, right? And we're going to see that movement. So that's why we wait for the fake break. We wait for strong liquidations to occur. But the idea around the PBL is that if the big guys are getting long and they're using that sell side liquidity, they should be able to take out supply and demand should be regaining control, okay? But if that supply holds and it does its job, well then this strong liquidation hasn't occurred, it hasn't worked, and we want to see a new one built, okay? So to keep it more simple, what you want to see is, again, step one. Always step one is you wait for the POI mitigation. At this very second your POI is mitigated and your alert goes off, what do we then ask? We ask, has there been a strong liquidation purely within the pullback, right? We're not looking at the leg, that's not relevant. We only look at pullback inducement, PBID, right? Has there been a fake break? Yes, it's the exact same example as here. There has been a fake break, right? This low broke that high, that is a strong low, and that has been liquidated. But once we get the mitigation and we look for that, what's the key difference here? Well, when we identify the PBL, which is the supply that liquidated this low, is it still active? Yes, price has not mitigated it at this point. When price is here, it has not mitigated it and it has not caused a new low. Therefore, that's a way we define that this liquidation is still relevant to this POI and this bullish idea. Okay? And the whole reason why is it's simply just to help us with, sometimes you'll get big volatile ranges, you'll get a strong liquidation up here, and then price comes all the way down, and then we get the retrace candle, that our entry. It's like, well, is this relevant? This is the mechanical solution that we have as a potential idea that you can use, okay? So this is invalid simply because when we get the mitigation, we can see it already held and made a new low, whereas this is valid because it's still active. So at that point, if we get triggered into the trade, we're just in the trade. We don't care what happens at that point, whether it gets stopped out or we hit target, whatever, okay? So it's up to you whether you want to use this rule or not. So what I'm going to do is I'm going to show you an example on the charts, but then I'm also going to show you an exception to the rule where I will ignore a PBL mitigation, okay? And I'm going to show you that. So again, it's up to you whether you want to use this rule or not. What I found in my testing is that this here doesn't seem to happen that often. I didn't really notice it. So I've actually struggled to find some real chart examples to show you of when this occurs. So it's not a very, very common thing, at least what I didn't very notice it. Maybe my brain was turned off to it. So you don't need to worry about it too much, but I think it's a good rule if some of you are kind of looking at liquidations very, very far away and wondering, should I be taking this trade? So let's look at some examples. So this trade here is not a high probability trade at all due to the medium time frame idea. That's not why I'm showing the example. I'm showing you this purely because it's only one I could find where there is what we're talking about with the PBL, okay? So, the basic idea of this is obviously the M15 structure has shifted bullish, and this is a M15 demand zone that led to a break of structure. The reason why I don't view this as a high probability trade idea is because I don't view this as a high probability POI. When you get these kind of straight pushes, for me, this is one structural leg. This is basically just a pause in price action. It's got one straight push, it's got no leg inducement. Very often these sorts of POIs will fail. Not all the time, but a lot of the times, right? You want to see a nice structural pullback like this. I basically view this as one leg, like a little pause in price action. Yeah, those POIs, when you kind of see them form like this, I just don't really have a lot of trust in them. But anyway, let's say we want to trade from this POI, right? We can do that if you so wish to choose so. So the M5 is going to be our execution time frame. So the first thing we do is we wait for our POI mitigation, okay? So we get our POI mitigation here. So then our next question is, has there been a strong liquidation? Well, technically we need to take the low to the left, okay? Because this was where that last fake break occurred. So it's a bit more of a unusual example, okay? Because, ideally we want to be focusing on the most recent price action, okay? But if we are very strict with kind of how we should be doing this, this is where that last fake break occurred here. So I'm just going to put this on as my M5 chalk. Okay, so once we got that fake break there, this is the extreme low of that movement, right? So then we can wait for it to get liquidated here. So once we get our POI mitigation, we can identify, was there strong liquidation? Yes, this is where it got liquidated. So then we can identify the PBL, right? We ask ourselves, is this relevant? Well, here is the supply that liquidated that low. Now, this obviously hasn't been mitigated. We now have our mitigation. So if you wanted to take this trade, I'm not advising that you do, but if you did, that's essentially how you would now place your order, okay? Because we have the POI mitigation, we have the liquidation, the PBL is still active, right? So this means that this liquidation is relevant, okay? And that's how you would set it. Now, whether you want to take, again, I'm going to keep reiterating, this is not a high probability trade at all. Like you can't even get one-to-one to the M15 high, et cetera, et cetera. But I'm just saying, if you wanted to take this entry model, it would be like that, okay? Next candle is an inside bar, so you would leave your order on if you wanted to take this trade. And then we push down. So obviously you would cancel the order the very second that low fails, and then you would wait for this new candle to finish printing, okay? So now we have a bit of a smaller candle, which obviously increases your risk to reward and all that stuff, right? Depending on your stop loss buffer and how you want to manage the trade. It's not relevant to this lesson, but that's how you would then place your order, okay? If you still wanted to take this trade. And there we go. So you'd be in the trade. So this is an example where the PBL isn't really that relevant because it hasn't been mitigated. So you can just take the trade and you would be in. Now, as we can see in this example, the PBL ends up holding, and eventually, as we push down, we'd get stopped out here if you took that trade, okay? So that's fine. Now, let's forget about that trade for a second and whatever. Imagine you still want to trade from this POI and you like this trade idea. Well, the first entry has occurred and that would have been a loser, depending, you might still be in it if your stop loss is wide or whatever, but let's just assume it was a loser. Now, it's up to you whether or not you want to keep trading from this POI, okay? But if you do, you need to see a new strong liquidation occur in order to take a second entry if you follow the rules that I do. So do we have a new strong liquidation? Well, this low did what? When we took in that trade, another bullish change of character occurred, right? This low, there's a fractal pullback, and then price broke that high. So this means this is a strong low, right? That broke the high. So we now have another strong liquidation into our POI mitigation. So again, same thing. POI mitigation is step one. We're obviously within the POI. Step two, has there been a strong liquidation? Yes, we've just identified that, right? This low broke this high. That has now been liquidated. So then step three is, well, is this liquidation relevant? Is the PBL still active? Well, where is the supply that broke the low? It's here, right? This is the nearest supply that broke the low. Clearly, the PBL hasn't been mitigated and it hasn't made a new low. So that means this trade idea is active. So this is kind of a bit of a weird one. It's not quite like how I drew the example, right, where like kind of the PBL is far away. It's kind of all in one area, but it meets the same criteria. So the PBL hasn't done its job, but we do have a liquidation, we do have the POI mitigation. So that's an entry. Again, if you want to take this trade, that is how you would size it up. You would take it on that entry candle, okay? And that would be your trade. So next candle, what happens? Nothing happens, we get the inside bar. Okay, so we leave our order on. Again, another inside bar, we leave our order on, and then price breaks the low. Okay, so typically what you would do in that scenario is you would cancel your order, right, once that low breaks, and then because price is still within the POI, what would you then do? You would then set your order on top of this candle, right? That's normally what you would do. But hopefully you can now see that what has happened is price has pulled back into the PBL, the point before the liquidation. It has held, and now it's made a new low. So the PBL has done its job. Okay, so now actually, if you're following this rule and you're being strict with that rule, you are no longer interested in this trade idea. And if you wanted to keep trading from this POI, you would need to see new liquidity built and taken. You would need to see another fake break, right? Like a break at that high. This would then be your strong low. And then you want to see another liquidation and then you could take the entry. Okay, so that's a bit more of a subtle example, right? Because actually when you do get the initial liquidation, the PBL wasn't mitigated. Therefore, you could set your entry order above that liquidation candle. But then as it keeps going, what do you notice? Pull back into the PBL, it made a new low, candle closure below the low, right? Clear structural pullback into there, and then a clear new low. So again, if you want to follow that rule, trade idea would be over. Let's wait for new liquidity to be built. Does that happen? No. And now the POI has failed, so now the trade idea is over, okay? Because the POI must be respected in order to take this entry model. Okay, so I'm going to show you an exception to that rule in a second, but just to recap, keep an eye on this, right? If you notice there's a clear pullback, you kind of want to see a clear structural movement, a clear structural pullback, like at least a fractal pullback into it, and then a new fractal low, and then you get the mitigation. Then obviously that's not valid. You want to see a new liquidation, or this was a bit more of a subtle example where actually the entry was initially valid, but then whilst we're waiting to be tagged in, it then became invalid because we had that pullback into there and a movement down. Okay, so that's not quite an example of where it like happens far away. I couldn't quite find one of that, but hopefully all the logic is still the same and it makes sense. Now I'm going to show you one exception to this rule. So the exception to the rule is basically when well, let's just get into it and then I'll explain why. But it's basically when you have a very high probable scenario and you just want to get involved. So daily chart, we are clearly bullish. We pulled all the way back into the extreme. So this is obviously, we want to start thinking about catching that next bullish daily leg to the upside. Longs are going to start becoming high probability if our lower time frames start to confirm that. So we're within the daily demand. I haven't drawn on. We've come into this 4-hour extreme demand as well. Now we zoom into the more recent price action on the 4-hour chart. We're obviously bearish, right? We're moving to the downside. We last had a 4-hour break of structure here and we're quite overextended. So we know there's a pretty high chance that we're going to get at least a 4-hour pullback, right? We're coming to the extreme of the daily demand zone. The daily's bullish, so we're going to expect a bullish reaction. The 4-hour is bearish, but we can expect that 4-hour pullback to kick in. So we're starting to stack probabilities in our favor of getting that bullish movement. Now it's a bit more subtle, but if we zoom in, we can see that we have had a 4-hour bullish change of character. So that's another good sign that some bullish pressure is coming in, right? We've had the fractal take of the low, fractal take of the high, bullish change of character. If we jump down to the M15, just going to play it forward a little bit. Okay, what do we get? We get a clear bullish shift in M15 structure. Okay, took the low, and then we took the highest point. Okay, and then we got a bullish boss. So now, what have we had? We've had that daily mitigation of the extreme demand when it's bullish at a strong low. The 4-hour charts come into that level and hit the refined 4-hour demand that I haven't drawn on within there. We've had a 4-hour bullish change of character. The M15 has now clearly shifted bullish. We've had a nice big liquidation of these lows as well, okay? Just some extra confluence. Nice big V-shaped reaction. So this is actually the type of example where this is very high probability for me, and I would actually consider setting a risk entry on my medium time frame POI. When I see this sort of price action, I'm just looking for an excuse to get involved. I want to get in long, and I would consider setting here a risk entry here. Of course, we also have the extreme that we can keep an eye on. But yeah, start of that new pullback, strong momentum, prices rarely in these scenarios pulls all the way back down to here. So I'd be very happy to set a risk entry. But let's say we're looking at the LC2A on the M5, okay? So what do we need to wait for? We need to wait for our POI mitigation, okay? So if you're doing this live market, you just set your alert and you would wait for your POI to get mitigated. So now your mitigation happens, alert goes off, okay? That's step one. Step two, has a strong liquidation already occurred within the pullback, right? But only looking at strong lows within the pullback. This low didn't break any highs. Okay, this low, that's all one down movement. So that didn't break any highs, so that's not a strong liquidation. This low didn't break any strong highs. Now this one is a bit more subtle, and this is where you have to be really careful and not rushing when you're backtesting. It's almost a little bit easier in a live market to spot entries because you see price action form and it's easy to see it and keep track of it. People can very easily miss this when you're backtesting, okay? So what has happened here, I'm going to bring it back so we can see, is at this moment, the fractal high is here, okay? We can see that, right? That's that last fractal pullback. So that's the fractal high. If we play forward the next candle, nothing happens. Then the next candle, it takes the high and then it takes the low, okay? So again, it'll be a little bit easier to see when you're trading live, but the way this forms, you can check on a lower time frame if you don't believe me. Price moves up. So the very, very second that price breaks that high and causes that bullish change of character, whereas the fractal low, it's down here, okay? So we have an up movement, causes a bullish chalk. This then becomes a strong low. This can potentially be our fake break to the upside, and then price comes down and liquidates that low, okay? So now what do we have? Now we have a strong liquidation on the M5, okay? Now, at this point, you now have a valid PBR, right? This is the supply that caused the break of this low. Now we play price forward one more candle, price pulls back into that supply, into that PBO and fills up some of the orders. And now what happens? Now price goes to the downside. So if you're coming to a chart at this point, you go, right, step one, POI mitigation, yes, tick. Step two, has there been a strong liquidation? Yes, it was a bit more subtle, but we can see, right? Break of the high, that was a strong low, that low gets liquidated. Okay, step two, we do have a strong liquidation. Step three, is that strong liquidation still valid and relevant for our bullish idea? Well, if you are 100% strict with the PBL rule, no. Because when that PBL was created, what happened with this next candle at 1:05 p.m., price pulled back into that supply, filled up those orders, and then technically made a new low, okay? So there's two reasons as to why you can make an exception here and ignore this rule. The first one, and probably the more important one, as always, is because of the medium time frame idea and the medium time frame POI. For the reasons I explained, looking at the daily chart, again, I'm going to go over it. This is very, very, very high probability for me. Bullish daily chart, we pulled that down into the daily extreme, big risk reward on our side. Obviously, I'm not going to be targeting that move, but this is the area in which we can start getting aggressive in longs. It makes sense. 4-hour chart is starting to back that up. It's still bearish, so long as a counter 4-hour chart. But look how overextended we are after the boss. We're expecting the pullback. We had a bullish 4-hour change of character. The M15 is even better, right? Nice big strong liquidation, which is another sign that potentially, that bullish pressure is going to start coming in. We then get that confirmed with a nice big strong bullish move, giving us our bullish break of structure. We have a clear POI, right? A lot of momentum came in. Very often when you get that initial trend change, price won't always pull back to the extreme. This is the exact type of POI, right? Nice sweep where I would consider even setting a risk entry. Okay, so the medium time frame idea is very, very high probability, and that's why I'm just looking for an excuse to get involved. And this is the most important thing about the entire strategy is your medium time frame idea and your medium time frame POI selection. So I already know I want to get involved anyway, so I'm almost willing to ignore the PBL in this scenario. But the second reason that helps me to ignore the PBL in this scenario is how the mitigation formed, okay? Because really, it's like, if we just look at structure for a minute, and I delete these drawings, it's just kind of one fractal leg down, right? All of these candles break the previous candle's low. Really, it's just one movement down to the downside on the M5, okay? What would be different is if we came down, we had a clear structural pullback into the PBL, right? Mitigate those orders, and then had a clear structural break to the downside, right? Like this is a straight movement down. That's a structural pullback into this supply zone. And then we get like another leg down. That's kind of what I mean. Whereas this is kind of just one movement. It's just efficient price action. So you have to really ask yourself, do you care about it as much? Like in this one, right? Again, that's a little bit more subtle, but you still have that fractal pullback and then you have the movement down. Whereas this, it's kind of just one leg. So when I see kind of just efficient corrective price action like that, rather than a down movement, a clear pullback and a down movement, and combined with the fact, and this is the more important fact, of how high probable the scenario is, that's where I'm willing to ignore that, and I just want to get involved. And at this point, we've had the mitigation, we had the strong liquidation. I'm not going to redraw it because you guys can see it, and I would set my order on here, and there we go, right? Okay, inside bar, nothing happens, leave the order on. Okay, that low breaks, so we cancel our order straight away. Wait for this candle to close. This POI is still being respected, therefore the trade idea is still valid. Reset the order, okay, and then you're tagged into the position, and then what will be will be. So a bit of a longer lesson on sort of a quick common mistake, but it's a current idea that we have, a mechanical idea for really trying to solve this problem, because I can't really find a perfect example of it, but sometimes the liquidation is very, very far away. I think it happens on GU a lot more because the price action ranges are a lot more volatile and bigger, but this is our solution to that. So some of you may still want to use some discretion, and if you see that this is miles away, you're probably just going to ignore it anyway, and you might want to see something more relevant. But whilst you're testing, this is a good mechanical rule that you can use. But I've also shown you where you may want to use a little bit of discretion and ignore it, because that's personally what I'm going to do. I'm going to use that little bit of discretion and go, do you know what? The medium time frame idea and the medium time frame POI is way more important to me. The lower time frame entry model is simply a timing mechanism for those ideas. So if we're right in this area, tiny POI was being super accurate anyway, like I just want to look to get involved, right? For me, I'm going to ignore that. So hopefully that makes sense, and hopefully it's a nice solution if some of you are questioning whether or not a liquidation is still relevant. So as we saw in the previous lesson, one of the sorts of problems or questions that can arise when trading this entry model is that once we have step one, which is the POI mitigation, our medium time frame POI mitigation, and then we do step two, which is to look, first of all, is there a strong liquidation in the pullback? Yes, we have a low that broke a high, we have a strong liquidation. Okay, we have 2 steps. Step 3 is then, is this liquidation still relevant for us trading this POI, this idea? Okay, because the idea is that we're trying to get long from this POI, and we are trying to anticipate that, that institutional order flow is going to continue bullish, and we want to see that there's been a strong liquidation first. Okay, there has been one, but sometimes there can be one that's quite far away, like in terms of vertical distance. This looks really, really far away. So the question is like, is that still relevant? Are they really using the liquidity behind that low in order to get long, like all the way down here? Or sometimes it's more of like a horizontal distance, where like, perhaps price is up here and it just corrects all the way through Asia, and it's kind of like all the way like this, like this, like this. And you come to like the London session or whatever, and it's like, okay, we've taken that low over here. Is that still relevant, that liquidation over here, for us getting long here? Now, some of you might want to use discretion, because
You might think it is. Like the best textbook trades are where like it's just obvious, right? The strong liquidation literally occurs just before or within your POI, right? Price comes in, you get the fake break, you get the liquidation. It's right within the POI. It's right in the immediate price action that forms right in front of your eyes. Bang. There's no real if, buts, or maybes. Okay, but sometimes these trades do play out where the liquidation is a bit far away. So if you don't want to use discretion and you want a mechanical rule, well, you saw the first rule that we suggested in the previous lesson, and that's the PBL method, right? So that is this diagram here where when we get step 1, okay, POI mitigation. Step 2, was there a strong liquidation? Yes, we have a low that broke a high that then got liquidated. Step 3, is this liquidation still relevant? Well, in this case, no, because price already pulled back to the PBL, the point before the liquidation, the supply that took out that low. The PBL then held and it made a candle body closure break of the low. It made a new low. So if you use the PBL method to define whether or not these liquidations are still relevant for us getting long here, then this would be invalid for you, right? Because the PBL held and it made a new low by the time that we're looking for the entry. Whereas here, yes, we get the strong liquidation, we've got the POI mitigation, but we can take this trade because the PBL didn't get mitigated and it didn't make a new low, right? So if you're not comfortable and you don't understand the PBL method, please go and watch the previous video to make sure you understand it. That, at the time of recording, is the method that I personally use. It's the method that I've tested. And yeah, that's the one, well, I've used it. But in this lesson, you're learning the second method, and that is the early entry invalidation method. So essentially what this method does is, if I just show these candles, is if it gives an entry before your POI mitigation, then it's no longer valid. Okay, so what that means is we get our POI mitigation step 1, right? Step 2, has there been a strong liquidation? Yes, we can see that there was a strong liquidation here. We got the fake break, that then got liquidated. But what we then need to study is the price action from that liquidation before we get our POI mitigation. And if we can see that it basically already has given an entry before we get our mitigation, then it's no longer valid. So as we can see, we got the liquidation here, price is then moving down, but then what do we get? We get a candle that breaks the previous candle's high. So that technically would be an entry if this was within our POI, right? Because we would have been tagged into the position, because we'd be following the liquidation down and then price moves up and it would have tagged us in, right? So if that was, after a POI mitigation, that would be a valid entry. So when we actually get our POI mitigation and we're looking to see, okay, can we still trade the strong liquidation here? But you use the this second method, which is called the early entry invalidation method, and that could be a better name. But as we can see, right, it broke the previous candle's high, therefore this would have been an entry. That now means this trade idea is no longer valid for you, and you would need to see a new strong liquidation form. Okay, so to say that again, step 1, POI mitigation, yes. Step 2, do we have a strong liquidation? Yes. Step 3, is this strong liquidation still valid? Well, with this method, the early entry invalidation method, it's no longer relevant because it gave an entry here. Now, this is not an entry we're going to take. Why? Because there's no POI mitigation at this point, right? We need the POI mitigation. But as you can see, because it did break the high and essentially it gave an entry, it's not a valid entry, but it gave an entry in terms of the lower time frame price action, that now means it's no longer valid. And you would need to see a new strong liquidation built here. You need to see a new fake break and give you a new entry. So yeah, that's basically it. I'll just show you one more diagram. So this is where you have the two methods side by side. So in the previous lesson, we learned the PBL method, right? Once we get our POI mitigation, if the PBL was already held and made a new low, then we don't look for a trade. That's one method. Okay, so you only use one method. You don't use both. You have to pick one, right? So that's the PBL method that we learned before. In this lesson, we're calling it the early entry method, the early entry invalidation method, whatever. And basically, once you get the strong liquidation, if it gives an early entry here before we get our POI mitigation, then this liquidation is invalidated and you need to see a new one form. Okay? So again, you pick one. You do not use both. Pick one and stick to it consistently. I personally have tested this one. I haven't tested this approach, but Tomas has used this approach with his testing. He just preferred that way. It resonated with him more. So yeah, just pick one, test it, see what works for you. I don't have the data to kind of say which one is better because I haven't tested this approach. I would say in theory, I could be wrong, but in theory, this approach to me would seem more conservative, because I'm happy if price does give that early entry, but then comes in here. I'm still happy to trade that liquidation. Whereas if you use this method, then obviously it's no longer valid. I personally use the PBL method. Okay, so yeah, I'll just go over that one more time. If the strong liquidation occurs and price is pulling back, but then it gives that entry before we get the POI mitigation, then this liquidation is no longer valid, and you would need to see a new one form. Okay, it really is as simple as that. So let's take a look at a real example. Alrighty, so I was actually struggling to find kind of a good price action example to show you. So what I've done here is I've kind of made up where the medium time frame POI is. I think the true one is more like this, but just for me to explain the example, imagine that this is kind of where the actual medium time frame POI is. Okay, so obviously step one, we need to wait for the medium time frame POI mitigation first. Okay, now we've got it, right? So imagine we want to trade short from this M15 POI and we're looking for that entry. Okay, so we have step one, which is the POI mitigation. Step two, do we have a strong liquidation? Well, a tip to kind of do this is just look at the next nearest high. Is this a strong liquidation here? Well, did this high achieve anything? Did it break any structure to the left? No, it didn't break any lows to the left. So that is a weak high. It is not a strong liquidation. So now let's look at the next highest high. It would be this high here. Was this a strong high? Did it break any structure to the left? Yes, we can see it broke that low. Okay, so here we have a high that broke an M5 low to the left, right? It caused an M5 chock. So now we take the highest point that caused a break of that low, right? We always take the highest point for the strong liquidation. Okay, so now step one, POI mitigation. Step two, strong liquidation. Step three, is this strong liquidation still relevant for this POI? Well, how do we define that? Well, if we're using the early entry invalidation method number two, we have to see, since the strong liquidation occurred here, did it give an entry? Okay, well, from this candle, if we were entering short, does price break the candle's low? No, it pushes up first. Okay, and then if we were entering short on this candle, does price break the previous candle's low? No, it pushes up. So then we'd be tracking to this candle, right? Now, the next candle does break that candle's low. So what that means is if we were in the POI at this point and we did have the POI mitigation, and then you were looking to trade this short, so you'd have your stop order below this candle's low, right? If we move it there, and you'd have your stop loss behind the high, that means it's already given an entry. Because we got the liquidation here, this candle breaks the previous candle's high, breaks that candle's high, breaks that candle's high. So we'd be moving our entry, our sell stop below each candle, right? And then here, this candle breaks the previous candle's lows first, and then it pushes up. So we would be in the trade if that was a POI mitigation, okay? But it wasn't, because we're saying the M15 POI is up here. So because it gave an entry here on this 345 candle, that means there has now been an early entry, and therefore, if you use this method, once we get the POI mitigation, this liquidation is no longer relevant for us. It's no longer valid because there was an entry here, because this candle broke the previous candle's low, and that would have given an entry, and then you would be in the trade. Okay, so that's method two. It's a horrible name, but we're calling it the early entry invalidation method. It gave an entry here, so therefore by the time we get a POI mitigation, we say that this liquidation is no longer valid. Therefore, if you want to trade from here, what do you need to see? You need to see a high that breaks a low, and then you would look for that strong liquidation here, and then that would give you a valid entry. Okay, you need to see new strong liquidity built if you use this method. If you use the PBL method, is this trade idea still valid? Method one, well, where's the PBL? We look for the demand that liquidated this high. So this is where the high gets liquidated. So we look back, where's the valid demand? This to me would be the clear pivot demand that led to the break of that high. And as we can see, it's completely unmitigated. Therefore, if you use the PBL method, then now you are allowed to take this trade, because step one, POI mitigation. Step two, is there a strong liquidation? Yes, we have a high here that broke the low to the left, so we have a valid strong liquidation. Step three, is this strong liquidation still relevant for this POI? If we use the PBL method, it is, because the PBL is unmitigated, right? Otherwise, we would have to seen a mitigation and it caused a higher high. If it had done that, then we would say, yes, the PBL has done its job, therefore we would need to see a new strong liquidation. But it hasn't. So the PBL method, this would be a valid entry, okay? And you could take this short. If you use the second method, the early entry invalidation method, right, then we can't take this trade. This liquidation is no longer relevant. Why? Because it gave an entry here. you would have got short on this candle here because price broke the low, you would have been tagged in, right? Obviously, that's not a trade we take because we didn't have the POI mitigation, but the fact that it gave an early entry means it's invalid now and you need to see a new one. So that really is as clear as I can make it. Hopefully there's not too much confusion around that. But yeah, the key thing is that you pick one method. If you want a mechanical method for solving the question of, is this liquidation still relevant? Either use the PBL method or use the early entry invalidation method. Okay, I personally have only tested this approach. Tomas has tested the early entry invalidation method, okay, with the swing trading in his approach, but I wouldn't say one is necessarily better than the other. Pick what one you resonate with, maybe just forward test both and keep an eye on it and see how you go. Like I said, I think in theory, the early invalidation method would be a bit more conservative because it's much more likely to cancel trades, sort of invalidate them for you, but I could be completely wrong. I haven't tested the data, I don't know, but there are two 100% mechanical methods that you can use, but pick one, and yeah, just see how you go with it.
Alrighty, so obviously I want to try and show you, a decent amount of trade examples so you guys can truly understand, this entry model inside out, and then you can go away and do your own testing before potentially implementing it into a live market if you, so choose to do so. But the way I think it would be good to kind of go through these examples is how you can probably see I'm splitting them up between what I believe to be low probability setups, the medium probability setups, and then those high probability setups. Now, obviously, it's a bit of discretion as to exactly how you categorize the trades between those, but I'm going to try and make the distinctions as clear as possible. And we'll go from there. So really, in my opinion, what defines probability is wrapping your head around the medium time frame phases cheat sheet. So if you haven't seen this original lesson, I'll link it below in the notes below the video. Please make sure you're very comfortable with it. If you've been here a while in Photon or if you've watched the course already, you should get this. And really what this medium time frame phases cheat sheet does is it distills sort of everything that's bubbling away in my subconscious of how I read the market and sort of the years of experience that's in there. We try to distill it into sort of this mechanical cheat sheet so you can kind of understand how to think about the market in almost every single scenario and phase that it can be in, to then go, right, I'm in phase C, this is what the objective of phase C is, right? If we look over here to the right, and therefore these are the best times in which I want to be trading that, trading price action if a setup occurs, if it's in phase C, right? So that way you can kind of know how to deal with the many variables of the strategy, right? Because we can all find a medium time frame zone and we can all then see the entry model in there and then hit it. But really what will separate, your results from losing or from break even to then actually truly pulling away, having that higher strike rate and starting to compound your results in the long run will be wrapping your head around this, in my opinion. So what I would encourage you to do is when you begin your testing and also when you're live trading and you're forward testing it, make sure you journal and categorize the trades in these phases. And then when you have collected a big enough sample size that is, hopefully statistically significant, you will start to see those stats come through and realize, in some scenarios, actually these phases, I have a much lower strike rate in, or they're just not really overall giving enough return for me to justify trading when prices in those phases, right? The data will kind of show that to you. So first one we're going to kick off is low probability. Let's look at what those setups are. And generally, at least I have found, they kind of come in these phases. So phase A2, phase B, phase D, and phase ranges. And I'll go through these one by one now to try and make those clear. So what is phase A2? Because this is not something that's on here, and I didn't include it in the original lesson. Well, it's kind of, a slight evolvement. Someone actually first called it in the community. I can't quite remember who it is, so sorry for not giving credit to you. But I first remember seeing someone refer to phase A2, and basically that's when we are trading pro medium time frame swing and pro medium time frame internal structure, right? So it's all aligned, but we're doing it after the boss has occurred, right? So phase A is here when you're pro internal and pro swing, right? We're getting long, and it's here as well where the green box is. But after we get the boss, we know that the internal structure can still stay bullish for a little while, right? And technically this area here is phase A with our cheat sheet, but we're now going to call that phase A2 because buying up here after the boss is very different from buying down here. Okay, why is that? Well, down here, we've pulled all the way back to an area of value. We've mitigated the extreme demand at the strong low, and our internal structure has now shifted bullish, right? So then when we're coming back into here, this is that first end of the pullback. Risk to reward is on our side, and more often than not, this is a really high probable area to get involved to try and capture that next swing leg. Now, obviously, the higher we get within this range, the sort of the lower probability that comes because risk to reward isn't quite on our side as we're coming up towards these highs, or sometimes price can kind of range for a bit before it goes, right? I'm sure we've all experienced that. But phase A2 is when the internal structure remains bullish, but it's after the boss. Now, after the boss, we know what can we expect. We can expect a swing pullback to kick in at any moment. So following the internal structure up here is a lot riskier than buying it down here after that initial IBOS. Okay, so basically we're calling this up here phase A2. And you will find on average, those trades tend to be, or at least I classify them on the lower end of medium probability. And most of the times it's a low probability trade. Okay, because often generally that pullback comes in, or you might get a bounce from medium time frame demand, but you can't quite hit your profit target, and then you get a break even or a loss depending on how you manage, and it isn't quite worth it. So it's not to say that you should never trade these A2 positions. It's just that, again, more often than not, they lean towards the lower end of the strike rate. So you have to be a lot more experienced and disciplined for when to execute them. Generally, I'll kind of show you in a minute when we get into the charts of when to do it, but it's generally when like momentum is super, super strong. It's like the new start of a 4-hour leg or a higher time frame leg. There's no opposing supply or demand or liquidity points in your way. It's kind of almost like where you can see in a chart that like price is almost ready to free fall or fly because there's like nothing in the way. That is kind of when you can get away with it, and I will show you that, okay? But for the most part, after a boss, you want to be a lot more cautious with kind of following the trend. And yeah, that would just be my general advice. The next one is phase B. Now this is when you are trading in line with the swing structure, but you are against the internal structure. And I've said here when the best time is to trade phase B, and it's basically here. It's pretty much when you come into the extreme strong swing low and you are expecting the internal structure to shift bullish, right? Because it's going to have to shift bullish here if the swing structure is going to stay bullish, right? If this low is going to hold and we mitigate the extreme level of demand, right, then we're expecting the internal structure to reverse. So that's the best time to trade against the internal, right? Because it makes sense that we're about to see that reversal. This is the best time to trade phase B, right at the extreme. And even maybe waiting for like an M15 shock or a medium time frame shock can even help with that, because at that moment you are trading against that internal structure and order flow, right? So this is an okay area to trade phase B. But generally the areas you get caught out that I view a low probability are when you do it, say like here, or maybe even like here, right? Because technically both of these areas are the same. They're both phase B. If you're buying, you are trading in line with the bullish swing structure, but you're against the internal structure. And the reason why here and here are far lower probability than here is because in these areas, if price mitigates something to the left here, what is the probability, you have to ask yourself in each scenario, what is the probability that the swing pullback is going to end here and we're going to see that internal reversal and we're going to go? Well, if there's demand lower down, if we're selling off with a lot of momentum, et cetera, then it's unlikely, right? Until we come down here. So that's why phase B is generally a bit of a lower strike rate unless you do it in the right areas, or you have good reason, good confidence to believe that these areas is where you're going to see that next leg. Or you have enough risk to reward just to play that internal pullback. You take your profits, you get out, you remove your risk. And then again, if you can get in early, maybe there's like a demand zone here, right? It's a bit more advanced. You have to have experience to know when to do that and when not. Generally, it's best to always be trading in line with the internal structure. You almost always want to be trading pro-internal or at least pro-fractal order flow. Like wait for that medium time frame shock first and then get involved, okay? The next obvious low probability one, which you're probably all aware of, is phase D, and that's when you're trading counter swing and counter internal. So you're just basically trading against everything on your medium time frame, right? When you're trying to short here, when everything is heavily bullish. Now I've gone into a lot more detail in the MTF phases lesson of when to do it. There's some more information in here. I don't want to make this lesson super long, but I would just say, just avoid this. Don't even bother doing it until you're a lot more experienced. And at a minimum, I would wait for like generally at least a medium time frame shock, and you want to be doing it from a very decent supply and demand zone generally backed up by the higher time frame, okay? But this is a very easy one to just leave out of your plan and not get FOMO if the setup plays out. Fine, whatever, it's fine. Just wait for phase C. This is a lot better, okay? So D is an easy one to leave until you're consistent. And then the final one is ranges. So very simply, this down the bottom, when there's no real clear higher time frame intentions, it happens, quite a lot of the times throughout the year. We'll just have the 4 hour ranging for a month or so. And ranges can be played, but there'll be times where like it's super messy or price is right in the middle. You will find that in the long run, you can probably break even or do quite, be profitable. But for the most part, it's easier just to stay out because you'll find the strike rate is a lot lower. So that's my experience on my own trading, my own data collection, and also what I see in the community where the majority of people take their losses. So it's not to say that you cannot trade any of these phases. It's just to say that these are typically a lot harder to trade with a higher strike rate. So just bear that in mind and use these phases to help categorize your trades when you are trading, when you're collecting data, and it will all start to become a lot clearer to you to help you to know how to approach those scenarios and whether you want to trade them or not. Okay, so hopefully that makes sense. Now let's just go look at a couple examples of what typically, not always, but typically are these lower probability setups. Alrighty, so let's look at a couple examples of what are typically on the lower end of the spectrum of probability trades. Okay, so in this instance, the 4 hour chart, let me just make this a little bit more obvious. So here we can see that the 4 hour chart was bullish, then it shifts bearish for a bit, and then we switch bullish, but we don't really get a swing pullback until all the way up here, which ends up meaning we have this really big swing range, and then eventually where we've brought the price action to, we eventually shift bearish. Okay, so the swing structure is bearish. Zooming in a little bit to kind of the more relevant price action when we have that, we can just see how clear that strong bearish order flow is with the internal structure. Tried to break the high, swept it, and then we just have traded off. So just looking at the last month or so price action, it's just heavily bearish, right? I think that's all pretty obvious for us to agree on. And then we can zoom into this most recent 4 hour range. So yes, after a 4 hour break of structure, we can expect that deeper 4 hour swing pullback. And obviously the internal structure will shift bullish to facilitate that when it's ready. But when I can see just this for the last month or so on the 4 hour chart, we're just selling off and selling off and selling off. Why am I going to fight that, right? The higher probable direction is still to the downside, right? Supply is being respected. We've just had an IBOS there. We've pulled back up into the EQ. We've mitigated that level of supply. We've started to push down. So, on the balance of probabilities, shorts are to the downside. Now, that said, before we even jump down to the medium time frame, we can see it's probably going to be ranging a bit because as we can see, price pulled back into the supply zone, it's pushed down, it's just wicked this low and then pushed back up, and then price is just training around. So when that happens and you see a large doji like that, you can already know before you go down a time frame that we're ranging, it's a little bit indecisive, and it's not so great. So the M15 swing structure in this instance, we were bearish. We just about shifted bullish here. We barely closed above that recent high, and then we shifted bearish again. After a boss, what we can expect? We can expect an M15 swing pullback. The internal structure then shifted bullish here to facilitate that swing pullback. We did actually have some volatility where we had a little bit of an internal pullback here. And then during the news, price shot up, caused a bullish IBOS, mitigated deeper into that 4 hour supply. Then we got the bearish IBOS. So then at this point you would think, okay, M15 swing pullback, we pull back up into 4 hour supply, bearish IBOS, now we're expecting the weak swing low to go, which happens by about 0.1 pips, okay? We failed to close below it, sweeping that liquidity, and then we've just pushed back inside. So technically, the M15 swing is bearish, this is our range, and technically that was our last bearish IBOS here, right? Because that was that last pullback and then the break. So technically, that's our internal high. This is our internal low and swing low, and that's our swing high. So on paper, the swing is bearish, and the internal structure is bearish, and the 4 hour internal is bearish. So you would think sales are pretty high probability still, but in reality, this is where I just define this as a range. We've swept the swing low, we're kind of aggressively putting back in, and really we're just changing between this high and this low. And very often when that happens, a lot of times in my pre-market analysis, if you've seen me guys share it, I'll basically just be like, we're trading between this high and low, and until we break out of this high low convincingly, trades within here are low probability. And really this is when you want to go to your phases cheat sheet and just go, right, no clear immediate intentions, stay out of the middle. You want to long in the bottom 33%. So the section down the bottom, the orange section down the bottom, or short in the top section. All right. And the best thing to do is literally just wait for a breakout, like I said, and try not to get caught out. But if you do get sucked into trading it, this is kind of where I want to show you that there will be winning trades, but there'll also be a lot of losing trades. So you kind of have to take them both in the chin if you don't want to do it. Now, one argument for bullish is that we did sweep the low, and since then we've had quite a big V-shaped retrace, and we're starting to form that bullish internal structure within the internal range. So you could argue that, okay, potentially we are going to see that to the upside, right? And this is where you can kind of get led into those positions that can kind of look good initially without really kind of, saying to yourself, well, I'm in a range, so I don't really want to get sucked into these positions, but essentially viewing that as your internal range. Okay, the session's open. This is the London session around 7 a.m. UK time. So it's like, are there any good POIs to trade from? Got that zone there. This has all been mitigated. You've got this range within here. It's probably like really are extreme within the range. Like this has been mitigated. This is all just slow corrective price action. It's a Monday as well, which isn't great. So yeah, so let's probably price forward and see if we can get a mitigation of a level to try and look for longs, right? If we were looking for low probability trades, kind of chopping around. Potentially you could justify it as like the sell to buy range if you wanted to. And yeah, the M5 is the entry time frame I'm using with this model, as you guys know. So let's say we wanted to trade from here long. We've had our first tick in the box, which is our POI mitigation. Okay, if you want to use that larger range I just drew on. Second thing, have we had a strong liquidation in the pullback? Well, this low did not break any structure, so that's not a strong liquidation. Now we've had a fake break. Let's see if we can get a liquidation of this low, and we can potentially get involved. We don't get it, and then we push up. Okay, so we pushed up, no strong liquidation there. That zone has been mitigated. Let's have a look at the M15. So we pushed up again. We failed to take out the high, so that's not a great sign. But you could look for the demand. Sometimes these will play out, kind of following that demand chain and see if we'll push up again. But can you already see now we're in a range? I've kind of explained that hopefully in detail. Not really want to be trading within here. I mean, technically you've even got this massive supply zone here that did cause a whip break of the low, but huge, kind of just ignore zones like that. This low has now failed to cause a counter body break of the high. Like this is where I just want to advise you guys, just stay away. Trade might play out, but is it really worth it? Well, let's look at some low probability trades if we come in. So we mitigate the demand zone, looking for strong liquidity to be built. So nothing's going on yet. We're just pulling back. Okay, finally, so this low breaks this high. So an M5 chock, which means now we can potentially have some strong liquidity below this low. So then you would set your alert and see if we can get a liquidation of that low. Okay, your alert would go off. We've now liquidated this low, right? So with the LC2A rules, the moment that liquidation happens, what do we need to wait for? We need to wait for the candle to finish printing, right? So this is a 115 candle. It will finish printing at 120 because it's a 5-minute candle. So imagine it's 120 now. Immediately, we will place our buy stop order above the high of this candle, give it a bit of a buffer depending on the spreads with your broker, and then we'll put our stop loss just behind. Again, whatever buffer you have decided on in your testing, it will also be dependent on the buffer, with the spreads your broker has. And we're going to aim for 3R, so it's going to be around about 3.3 depending on commissions, okay? And this will be it. So now we're either going to get tagged in or price will break the low of the candle. If price breaks the low of the candle, then we'll cancel our order. Let's see what happens next. Okay, we get tagged into the trade. So now we do nothing. We're just going to do set and forget. It's either a 3R win or a loss. Nothing to do. And then we get stopped out, okay? So just another example, really wanted to show the entry model, but I want to also do it under the guise of kind of, giving you more mini lessons on building the hard time frame narrative, POI selection. Hopefully, if you've been here a little while now, you would have known before we even looked at this that this was going to be not a great trade, right? Even obviously the title of the video is low probability. You guys can hopefully see range bound's not great. This low failed to cause a counter body, close of the high on the M15, etc., etc. Now, let's say you're kind of aggressive and you're stubborn and you just want to, or maybe don't have a good grasp of what is a high or low probability setup. You might go, well, we're still in the M15 POI. The trade idea is still valid because the POI has not failed yet. We haven't traded through it. So maybe you still want to get aggressive and get in long, right? Well, what do we need? We need a new strong liquidation. Well, this low, did it break any structure? Yes, it broke this high. So we've now had another M5 change of character here. So then this can be your new strong liquidation on the M5. Okay, so let's draw that in and bring this back. I'm just going to use this one. just bring this back one candle, because obviously this is when the liquidation happens. So once that candle closes, you need to wait for it to close, remember. Then you set your buy stop above the high, stop loss below the low, depending on what buffers you use, etc., etc. I don't want to keep repeating myself. Hopefully you guys know that bit now. We'll just say 3R, okay? And you would leave it here. Either get tagged in, or if the lower the candle breaks, then you cancel the order immediately. The lower the candle breaks, so you would cancel your order. You would wait for this candle to finish printing. Now, as long as price is still within the POI is still being respected, if you want to still get involved, you can, right? So again, wait for this candle to finish printing, stop above the high, stop loss below the low. Then it looks like you get tagged in first and then price goes down. So depending on your buffer, you might still be in. Some might still be in the trade. Yeah, I mean, your stop loss should be like a minimum of a pip, so 6-2, 7-2, and then you would have been stopped out there if it's tight. Maybe you're a bit looser. It depends on your buffer, right? Again, we'll get into this when we talk about the testing towards the end. But it's a low probability trade and price shops around, and depending on your stop loss, it eventually starts to move to the upside here, okay? So yeah, I mean, the main thing I want you to take away from this is the theory lesson before, where I went through the phases and the general ones which are low probable to try your best to stay out of for the most part. But collect the data in your testing, right? Maybe you want to take every setup, categorize them as low, medium, and high probability, and see how you get on. And if we just look at the M15 and bring it to the next day, okay, to around the London session, just get rid of this trade. So that potentially would have been a winner depending on your stop loss size. You go, right, we're seeing a continuation of this bullish order flow, right? We have a new strong internal low, like the internal of the internal, potentially if you want to get involved. Even these POIs are just rubbish, right? There's nothing really that obvious in here. You know, arguably like you've got this at the low, but just all of that sell side liquidity behind. Middle of the range, right? We're still within this until we break out that range. Not high probable. And also, where do you not want to be trading? In the middle of the range, just a place to stay out. Ideally, you want to be shorting here and buying down here, not in the middle. But again, we'll do one last position and let's just see. So we get our POI mitigation if you wanted to trade this. Do we have a strong liquidation? No, none of these lows broke any highs. So very, very simple. We just wait for that to happen. Okay, this low breaks this high. So we can then potentially see if we're going to get a liquidation of this level. There we get it. So the moment, let me bring it back so we can talk through it, because it's good to know these rules. The moment the liquidation occurs, right, you're ready to take an entry, but you need to wait for the candle to close. Entry, buy stop above the high, stop loss below the low, again, depending on what buffers you use. Target 3R. Now, these two candles, okay, they haven't broken the high to tag us in, and they also haven't broken the low of our entry candle, right, our liquidation candle, whatever you want to call it. So you do nothing, you wait. We either get tagged in, or you cancel the order once that low goes. So what happens next? We get tagged in. So now you just follow your management strategy, and we go, okay? And boom, another loss, because you're just trading in the middle, right? It's just not the place to be doing it. So I think you guys kind of get the point on that. We'll take a look at some medium probability and high probability trades in the next lessons. Actually, before we roll on, I just want to show you one more example, and this is going to be of a phase D trade. So this is essentially where you are trading just counter everything, okay? And it's more of a recent example. So not even going to bother drawing on loads of analysis. This was the trade we were looking at earlier, but we can see just for a long time now that price has just continued to sell off with clear bearish, bearish structure here on the 4-hour chart. And where I brought price back to is we just had a break of the 4-hour swing low. So potentially we can look to trade that 4-hour pullback. But if I zoom into the 4-hour price action, right, we don't have any structural shift to work with. Like we can see even the fractal structure is still bearish. So trying to get long now is pretty damn aggressive. We have no clear and obvious, recent demand zones nearby. So you can see how getting long would be pretty damn aggressive. Even without even doing any long-term, detailed analysis on the M15, we can just see how heavily bearish we are. We had a little bit of a shift of, some structural highs here that would have caught people on the wrong side of the market. We've had a strong liquidation there, but we're still selling off, right? Had a bit of a chop around with news, and there's just no real bullish signs yet. If we even look at the most recent fractal structure, right, when we took this low here, this would be our M15 fractal high. So this low right now has not broken any structure, this low down here. So to buy from here, you're buying from a weak low that has not broken anything, okay? So this is what we mean by like being an aggressive trader, taking those lower probable setups where they're just, we're objective and we list the confluence down. There's not a lot going for this, okay? Now over time, you can get more experience and you can go, right, I'm willing to be aggressive in this scenario because we're expecting the 4-hour pullback. We've already seen a sizable strong liquidation here with early longs getting caught on the wrong side of the market. Since that news, we've kind of been failing to really close below, these lows. We're starting to see bullish pressure coming in. We've seen a V-shaped reaction. We've got all of these Asia lows building in front of this POI, right? So you know what? I'm going to play, we're maybe viewing this as the start of a range before we get that hard time frame pullback. And you don't want to wait for that to occur. You're happy to see if you can hit like a quick long within it. Okay, whilst accepting that this on paper, on the long term, it's not great, right? Because you're trading from a weak low, but you're doing it for those kind of reasons I've explained. Okay, so I wouldn't recommend this, but it's just to kind of show you, the possibilities of how you can trade the market ugly. So we've got all of this Asian liquidity building up pre-London session. So let's jump down to our execution time frame, because what do we need to wait for? We need to wait for our POI mitigation, so we get it now. Okay, at this point we've had a mitigation. Now typically what I like to see is my favorite setups, right? It's price, and it's almost the immediate price action comes into your POI, or at least near your POI. You get the little chalk, you get the liquidation, we enter, and then hopefully sky's the limit. This is like a range, so technically this still meets the rules, right? This low did what? It broke structure. I mean, there's your immediate chalk there. But this low clearly broke some structure. And also what's great about it, right, is we've got the big sort of Asian liquidity sitting below it. So we can basically view this as our immediate M5 liquidation here. So this is a kind of a good example actually to go through the kind of the small details that you really want to pay attention to, especially when you're backtesting, because it's kind of easy to miss it as you skip through, right? So let's say you wanted to take this low probability trade. What do we have? We have our first thing. We have the POI mitigation. We have the strong liquidation. So the moment the liquidation candle closes, then we can set our buy stop order above the high, right? You guys know the drill about the buffers. And then let's just say we target 3R, right? Just keep it simple from now. Now, we either get tagged in, or if price breaks the low first, then we will cancel our order. Okay, it's a bit hard to tell when you backtest, so we drop down a time frame. Let's see what happened there. Well, we can see that we clearly broke the low before we broke the high. So because we broke the low first, the very moment that would have happened, which would have been at 7:30, we would have cancelled our order, right? So we wouldn't be in this trade because the low of this candle broke first. Once this candle finishes printing, then we can put our buy stop above the high of that, and obviously our stop loss below. Then we get tagged into the trade, so now we do nothing. We just follow our management strategy. Price pushes up again, and then it comes down and stops us out. Okay, so depending on your buffer, you would have needed a pretty big one in this instance. You've probably been stopped out of that trade. Okay, it is what it is. You've taken a loss there. The POI is now still being respected, so technically you can still play this medium time frame idea if you so wish to do so. We've pushed deeper into the EQ of the zone, filling up more orders. Now, remember, the devil is in the detail. Do we have a strong liquidation here? Well, this low caused a bullish M5 change of character when we were in that trade. So this low has broken that high, which then means we have a strong low, which then got taken out. So we've had a strong liquidation. So maybe if you didn't take the first trade, you might go, right, we've swept all these lows. We've now had an immediate liquidation during session. Maybe, you've seen enough to now get involved. Okay, so that liquidation occurs here with the AM candle. Wait for that to finish printing, stop above the high, stop loss below the low, right? And then you either get tagged in or the low of the candle breaks. Well, neither happened. So we leave our order on. We don't do anything at this stage. Then we get tagged in. So now we just follow whatever your management strategy is. And then you are in the trade there, okay? So low probable trade, phase D, 1 loss, 1 win. And there you go. So yeah, just wanted to show you one example, but I would stress focusing more on what I'm going to show you is I believe to be the medium and higher probable trades in the long run. And yeah, until you're a bit more experienced, stay away from phase D, buying from weak lows until you can, have that risk appetite and experience to do it in certain scenarios, or your strike rate will be a lot lower, which is easier said than done to deal with in reality, especially when you're trading significant capital. Alrighty, so let's take a look at some medium probability setups. So starting on the higher time frame, in this case, we're going to keep it simple and just start at the 4-hour chart. And we can see since we had that last 4-hour bullish cross here, we had a massive swing range. We formed clear bearish internal structure until eventually we took out that swing low to switch bearish. We then had another pullback and another swing break of the low. So we now have a clear 4-hour bearish swing range that we are working within. So if I zoom in a little bit, kind of looking at the more recent and relevant price action, especially if we're trading on the lower time frames intraday, we can see that we've had that 4-hour boss here. After a 4-hour break of structure, what do we expect? We expect a 4-hour swing pullback. Obviously, it doesn't always happen straight away. We had a bit of a pullback here, but relative to the recent price action, it's not enough to call that a swing structure, right? So we can just view that as a 4-hour internal pullback. We have had a break and closure below the low, so we've had that 4-hour bearish IBOS. So now the question becomes is, are we going to get another continuation of that 4-hour internal structure before we see that deeper swing pullback? Or is that the pullback already? We've kind of made these relatively equal lows. This could be the liquidation to then start that movement, right, where we get the bullish IBOS and then have that deeper pullback. Of course, if we were to look left, on the higher time frames, we could use the daily to assist us with that. But we're just going to keep it simple, like I said for now, and just think about 3 time frames. So in this sort of scenario, I am willing, to look for potential shorts from this 4-hour supply that caused the previous IBOS to see if we can look for some quick shorts whilst accepting the fact, right, that could be the liquidation to then start that deeper pullback, right? So already, hopefully you can see as to why this is kind of more of a medium probability trade, because even though, if we're looking for shorts within this 4-hour supply, we have the higher time frame on our side. We can't say that it's like high probability, right? Because we know that the internal structure could be about to switch bullish. High probability is going to be more like if we came into the 4-hour extreme supply, right? We had 4-hour bullish internal structure, we mitigated that level, then we switched bearish in the internal structure, and then we were coming into this strong 4-hour internal high where we have alignment with both the swing and internal bearish, right? That's going to be a lot higher probability, right? So hopefully that's kind of clear. So looking for quick shorts from this 4-hour supply zone. Let's see if the M15 is backing that up. So we can see nice clear M15 bearish swing structure where we had the break of that low, and then we started to form this bullish internal structure to facilitate that swing pullback. So if the M15 strong swing high is going to hold so that the M15 swing structure can remain bearish, right? So we can see the continuation of that 4-hour leg, then this is the high that needs to hold. We have extreme supply up here, nested within that 4-hour supply, and we have some nice lid there too. So it's looking like a pretty decent level to potentially look for shorts. But what we have to be aware of, again, remember the 4-hour can start that swing pullback phase at any moment. If that's the case, then the M15 will switch bullish. Then from an M15 internal structure perspective, you can see we're starting to form quite decent momentum, bullish M15 internal structure, okay? So we have to bear that in mind. So let's play this forward a little bit towards Frankfurt Open. So 7 a.m. Frankfurt Open has started. I'm just going to pull this back one candle. So from an M15 perspective, you can see that bullish internal structure continuing. But what else do we have, right? The devil is always in the detail. We had a bearish M15 change of character back here, that M15 shock, which means this is an M15 strong high, right? Because it caused the break of the low. So this potentially could be our strong M15 liquidation into our extreme. So let's have a look on the M5 if we want to take shorts from this extreme M15 supply zone. So what's the first thing we need to wait for anyway? We need to wait for a POI mitigation. So ding, 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 our alert goes off. There's our POI mitigation. So if you wanted to trade this idea, we have the POI mitigation. Second question, do we have a strong liquidation? Yes, we've just seen that on the M15. It's obviously also valid and relevant on the M5. Now, in an ideal world, I kind of prefer it where it's like in the really recent price action where you get that fake break, the liquidation, and then we enter here, and like the very recent price action that almost occurs, within or near the POI. But this is still, decent, right? It's still a strong liquidation that is very near our POI. So we can look to take this trade, right? We've had the liquidation here, but we can't enter on these liquidation candles because we need the POI mitigation. Now we have the POI mitigation. We can see the strong liquidation. We can see that the PBO is still active, right? The PBO has not been mitigated and done its job, right? So if price had say liquidated this level, came into the PBO and then made a higher high, and then we got the mitigation, then I would be looking for a new liquidation to form, okay? But that hasn't happened. The PBO is still active, so therefore we can take the trade. We can set our sell limit our sell stop order below the low. Obviously use your buffers, and we'll give this a bit of a room, give about a pip or so. All right, and then we can target our fixed 3.3, obviously net of commissions around 3R. So that would be the trade setup. We either get tagged in or price pushes up higher. If it pushes up higher, we'll cancel the order. Okay, we're tagged into the position, so now we do nothing. We either take a loss or we take a winner. Now, before I play this out, I do want to talk about the M15. What are the phases here? The phases is that we are shorting pro swing, but we are against the internal trend. So what does that bring us on our phase chart? It brings us on phase B. And this is what we're saying in the theory lesson for medium probability, that for phase B, generally it's always medium probability because we are trading against the internal structure. We don't have it on our side. So when is the time we want to do it? I've actually got the bearish example here. We want to be doing it at the top of the range, right? It's best used when the medium time frame swing pullback is likely going to finish, when we pull back past the EQ, right, when we're in the premium, and ideally it's when we're mitigating the extreme POI, right? This is kind of the last level that has to hold if we're going to continue down. So ideally we want to do phase B here rather than like here or even here, okay? And that's where we are today, which is why I think it's a trade worth taking, even though we are running the risk that this bullish internal structure can hold. There's a lot of strong momentum. We could easily come into this strong internal low, mitigate that demand and shoot up. Especially as, remember, the 4-hour chart, we are expecting that 4-hour swing pullback to potentially kick in. So this is why, for me, this trade would never hit that full high probability like category. But because of the area of value, because there's an M15 strong liquidation, right, not just an M5, we've got lid to the left, we've got 4-hour supply, the 4-hour internal swing are bearish, right? There's all those things, and potentially there's enough risk reward here for you. So they're just factors you're going to have to make into your decision making, right? We want to stick as much confluence on our side as possible, and let's see how this trade plays out, and it ends up being a winner there. Okay, so hopefully that's kind of clear as to just a standard medium probability trade, at least with the way that I view the markets. Let's take a look at one more medium example. So in this example, we have clear bullish daily swing structure. After the daily swing boss, we are clearly in the swing pullback phase, starting to form that bearish order flow and that bearish structure. If we zoom right in, we can see right where price action is. Now we actually have further room to the downside, further cause for lower prices, where we can see that bearish order flow. Price is pulling back into this daily very, very minor supply zone, right? Cause a break of that fractal low, and potentially there's room to come into this pivot demand before we potentially see the continuation of that swing trend. Or of course, we're mitigating this daily range. So there's a bit of bullish pressure coming in. If we look at the 4-hour chart, pretty much the same thing. We just got a bit of a smaller swing range here for the 4-hour swing range. And we have clearly forming that 4-hour bearish internal structure where, we are looking for potentially that to continue to the downside until that internal structure shifts bullish. So we can see that clear 4-hour internal range, right? After the 4-hour IBOS, what do we expect? We expect an internal pullback. It's a bit subtle to see, but there was a bullish 4-hour change of character as that fractal high broke that low. Then this candle came back up and caused the shock in there. Okay, so now we're looking to see if we can play this 4-hour internal pullback, potentially up to this supply, and then eventually we'd then look to see if the continuation of that movement there. So pretty decent, nice momentum, 4-hour bullish change of character, looking for quick longs to see if we can get the continuation up to there. Of course, if that is backed up by our medium time frame, which in this case is the M15. So here we can see the M15 forming, bullish structure where we've got that break to the upside, and then we've had another break of the high to there. So pretty simple, nice bullish momentum, clean bullish structure coming into towards Frankfurt open for the start of our London session. We can see price coming into this extreme sell to buy demand, right? That led to the break of the high. Nice corrective pullback in. Very typically, we would expect then price to then get that next impulsive leg to the upside. If we look left, we're not mitigating any super significant supply. Really, the main negative confluence factor is that we are trading against that 4-hour overall momentum, that 4-hour internal structure, that 4-hour order flow, and we have mitigated the top of that daily supply zone, right? Price doesn't have to come into our 4-hour supply to continue lower. So that is the main negative confluence, and as to why, again, this is a medium probable idea because it's still significant confluence against the idea, but I don't view it as a low probability trade because of how strong the M15 is in this instance, right? So look for longs from the extreme demand, nice momentum, nothing nearby to the left really. So let's see what we can find as we come into the session. So obviously, with the most recent price action here in M15, we can see we've just formed bearish order flow since New York and throughout the Asian session. So in an ideal world, we would see price start to shift a bit more bullish with that European volume kicking in, which we now get, right? So now we've got that internal break of structure here to the upside on the M15, confirming this low wants to hold, and now we've got a clear M15 demand zone to look potentially for quick longs to see if we can get the continuation of that next bullish M15 swing leg, right, to target this M15 high. So here's our POI. You guys know the drill. We now drop down and we wait for our alerts to go off on the M15 POI. I won't do the alert sound this time. I'll save you the embarrassment of that. Okay, so now we get our POI mitigation. First tick in the box, what's the next thing we need to look for? We need to look for, has there been a strong liquidation? Now this price action is a little bit messy, but if you actually look in, what happened is we came down, we've come up, right? We've come down, then we've come up, we've formed a bullish change of character here. So we actually had an initial M5 choke there, then we've come down, right? This same candle's come down, and then it's broken the high. Okay, so it's a little bit hard to see, but maybe I don't really want to drop down to a lower time frame in case it resets my chart. But essentially we've come up, we've come down, and then we break this high. So it's a bit of a subtle one to see, but if you check the lower time frames, you'll see this then becomes a strong low. Okay, so now we have a strong liquidation coming into our POI. Now this will be one of those ones that if you're sitting at your desk live, it will be a lot easier to see because you'll see the way in which the candles have formed, and then you'll know that this is in fact a low that broke a high. Okay, and now we have our strong liquidation. So at this point, we've seen everything we need to see. Strong liquidation, POI mitigation. We wait for this candle to close, 9:30. So at 9:35, we can place our order, offer above the high, and then whatever stop loss you are using, and then we can target our fixed 3R, okay? And that's that. So either we get tagged in, or if the lower the candle breaks, we'll cancel our order. Lower of the candle breaks, so the very minute the low of that breaks, we'll cancel our order, wait for the next candle to close. Is it still within the POI? Yes, the POI is still being respected. Therefore, we'll wait for this candle to close. We'll reset our order based on the new candle size, okay? And repeat the same process until we get tagged in. Now we get tagged in, so now we do nothing, set and forget management, and there is your quick and simple trade, okay? So again, what is that? That is pro M15 swing, pro M15 internal, so it's a phase A trade, okay? So if we look here, medium probability, phase A. Why is it medium rather than high? Because we've got everything in line. Well, we would counter the 4 hour. Although technically, if we look at the 4 hour chart, we are pro 4 hour swing because this is our swing. You know, how relevant is that to our M5 quick in and out trade? Not so much, right? I'm weighing a lot more importance on more of the recent and immediate price action. You know, that's clearly bearish. We're just playing the internal pullback. You know, we're trading kind of against that because we would expect the next higher probable leg to be to the downside, and we're trading against that daily supply mitigation. So it's not to say that I wouldn't take this trade. That's, of course I am, but it's just why it's not as high probable as it could be. But it's a good area to do it, right? We've still got nice risk to reward to target the high, in and out, there's your trade, decent medium probability trade. So let's take a look at what at least I deem to be, those real high probability trades in the next lesson. So high probability, what do we define that as? Well, I've kind of sort of made that clear in the previous lessons, but let's be very specific. For me, they generally are either going to be phase A or phase C. So let's talk about A first. As you guys know, it's pro swing and pro internal. And generally it's when it's that first initial phase. So we've pulled all the way back. We're into the strong medium time frame low that we are expecting to hold. The internal structure has just shifted bullish, right? It's very high probable now that price is going to want to target this high, and it's that first initial phase A. So we want to get in here. Risk to reward is on our side. We've got plenty of room. There's no opposing key levels to the left that we need to be too concerned about, and just almost everything is aligning. So kind of what I'm saying here, like pro the higher time frame as well. You kind of want that on your side, or at least just a lot of room that we're kind of trading in line with that initial higher time frame move, which I'll show you in the next lesson when we look at some examples. It's kind of that first initial phase of phase A, like after that first IBOS. That's what I was saying, like you get that initial IBOS, first pull back in. I love these kind of areas, almost sometimes where you can just consider taking a risk entry on a medium time frame and just get involved. And yeah, not really too much else to say. And then the exact opposite for phase C, it's where we come off a very significant level, ideally like higher time frame POI as well. Ideally, we've had that strong liquidation already. We see that nice big V shape coming off that level. Right, we get the bearish IBOS. It's that first initial phase. Right, we pull back into here. Like we haven't come off any significant demand to the left. There's plenty of risk towards the downside. Right, it's very high probable we're going to get at least another leg. You know, there's a big swing range to work within. I love these sorts of trades. This is when I typically find those higher probable trades. Now, do they occur that often where you have like everything fully aligned? No, but when they do, we want to make sure that we're confident. We don't want to be hesitating about taking losses in these areas. This is when I trade, with really high confidence that I will never be annoyed if I take a loss in that scenario, because I know that when I see this, it's time to put your foot on the gas and get involved. So without further ado, let's dive into some real examples. Alrighty, so let's take a look at what I deem to be, pretty damn high probable scenarios for us to look to get involved with. So we can clearly see that the 4-hour chart is bullish. We've had a very, very overextended run to the upside. So we're going to look to see if we can start to play that swing pullback. Now, if we zoom in a little bit, what can we see to give us confidence that the momentum isn't going to continue to the upside and we're actually ready to move to the downside? Well, this high on the 4H here caused a 4-hour bearish change of character, which means we have somewhat of a strong 4-hour high that has now been liquidated. So we've had that strong liquidation, which we know can help increase the probability that a swing pullback is ready to start, because potentially institutions have used the buy side liquidity behind that high in order to position themselves short. But what's better and even greater confirmation of that is we're starting to see kind of those first signs of bearish IBOSes, right? We're starting to see that structure shift, candle closes below the low, bigger bearish body candles are starting to kick in, right? These candles, you can start to see that bearish momentum kicking in. Okay, starting to see bearish order flow being respected with the fractal order flow there. And now we have this 4-hour supply zone here. So when I see price action like this, especially if it's lined up with the M15, I get pretty excited to want to get involved, right? Nice big overextended run. There's nothing of any real significance in this leg in terms of opposing key levels for us to short against, right? There's no like structural low here where price can sweep liquidity and push back up. There's no significant demand here, right? A lot of room and risk reward, almost like a vacuum in price for us to target to the downside. So when I see this, I really like it. Obviously, we can get chopped up a little bit when you try and get in early shorts, but when you've got the strong liquidation, starting to move down, starting to see clear bearish order flow, for me, that is go time, especially when you see it clear on the M15, right? Where we have shifted bearish here on the swing structure. We've then had another bearish boss, really to confirm that, because now we have both a confirmed lower low and a confirmed lower high. We have this 4-hour supply here. So in an ideal world, I would love to get short from this extreme M15 supply zone, right? Kind of like that phase B trade we looked at in the medium probability examples, where we could look to see if we get that strong liquidation into this extreme. But we know that price doesn't have to move up that high. We do have a liquidation of this M15 lid to the left. So let's draw that on. But so far, if we identify the M15 PBL, right, the demand that liquidated that lid to the left, we've had a mitigation, okay? Now that PBL has been tapped, but it hasn't made a higher high yet. So let's just play price a little bit forward into session open and just see what we can work with. So as Frankfurt pushes in around 6:30, we then get that PBL fail, okay? So this is then where you want to be on the ball and going right. Because this is kind of a mistake I see sometimes a lot in the community. It's completely understandable. I'm not having to go at anyone here. It's just something to like be aware of. Is we can do our pre-session analysis and we're like, right, we've kind of had a decent amount of momentum. We're correcting. Like at this point here, I'd probably be thinking, yeah, there's a decent probability price is probably going to push up another leg, just with the way it's looking. Potentially get a mitigation into this level, right? And then I'll look for the shorts. Or of course, you could then wait for the bearish IBOS, then look for the pullback, right? Something like that. That's what I'd be thinking at that point. But then when you start to see sort of this happen, where we've come into the PBL flip, we've pushed up, we've failed to put in a higher high, zoom in a bit, right? And then we're starting to come down with bigger momentum, right? Big sort of strong bearish close like that. So the PBL has failed. We've got a bearish change of character. We've swept liquidity to the left. We're within 4-hour supply. But again, it's the higher time frames are prime for me. I want to be thinking a little bit more aggressively of just like, right, I'm willing to start to look for shorts within here. And if I'm wrong and this is just an internal pullback to go higher, then I'll look for the short here, right? These are the areas in which it's like, I'm not going to wait for everything to be absolutely perfect when this is looking pretty decent already. So in this scenario, the M15 supply is a little bit messy because it's kind of a bit of a corrective range and then we push down. So you can kind of do it one or two ways. Just focus on this most recent pivot supply here, right, where clearly that momentum came in and caused, or you could be a little bit less refined and take from the bottom of the reaction to the top of the reaction, and you're essentially just taking that whole flip range there, right? Either way is valid, okay? So as we start to come into session open, let's see if we can potentially get that M5 entry. So we push down, okay? Now we have had a slight mitigation here, that is true, but if we look on the M15, okay, we haven't actually had a mitigate. We've just tapped the edge of the range, but we haven't quite mitigated into our refined pivot supply. Okay, it's more just like one kind of straight leg here. It's not like we initiated out, had a pull back in, and then we go. Okay, so I know that can be a bit confusing with sort of what is a true mitigation or not. Sometimes you have to read between the lines a little bit, but when you kind of just see one straight leg, right, it's just one fractal leg to the downside, it's in a high value area. If price comes back in and gives me my confirmations, I am more than willing to then look for the movement, look for a move within there, okay? Excuse me. So now we can look to see if we're going to build that fake break in the price action to the right. But of course, what do we need to see first? We need to see our POI mitigation. Now we get it, okay? Now we have our POI mitigation. Do we have a strong liquidation that we can work with? Well, what did this high do? This high did not break any structure. This high did break the structure. So we got an M5 chock there, which then means that this is an M5 strong liquidation here. There we go. The PBL is all the way down here. That clearly has not been mitigated and made a higher high. So that means that this trade idea is still valid. Like we have an active PBL, so we can look to get involved. We've now had the mitigation, we've had the strong liquidation. So sell stop below the low of that candle. Okay, we'll talk about stop loss buffers in like I keep saying in this upcoming statistics video, where I'll talk to you about how you can approach that. And yeah, let's see if we get tagged to the trade on this candle. Yes, we do. So now we're in the position, just target our fixed 3R and we start to move along. Now, depending on your management strategy, depending on your risk tolerance, you may want to also consider getting into potential scale-ins, depending on whether or not, how you want to approach already being in a position. Okay, it's gonna be down to you, but I just want to show you another potential opportunity, whether you missed that one or whether you wanted to scale in, right? Don't just sit in your lower time frame. The moment something's playing out, medium time frame is what you want to be focusing on. So now we have like a clear bearish IBOS to the downside. The momentum is clearly coming in, with London. It's go time now to try and target this low and potentially beyond that, right? For some of you, you don't have to do this fixed 3R stuff. You can, if you've got the skill and the experience and in these certain things that will happen a few times a year, these certain scenarios, a few times a year, maybe like once or twice a quarter where everything's aligning, good risk reward on your side, don't be afraid to potentially, allow yourself within your trade plan to have bigger technical targets, okay? We just recommend fixed targets to get you going, to get you consistent, to help with your psychology, to help trust your backtesting results, right? So you have a consistent method. But yeah, for those of you who are more experienced or will be more experienced in the future, do not be afraid to trust yourself in certain environments to try and push them a little bit further. Because if you catch 1 to 5 trades a year that are, 10R, 15R, maybe 20R, not saying it's easy or psychologically easy, that's going to have a big boost, that kind of little mini quantum leaps. Mini quantum, I know that's a bit of an oxymoron, but do you know what I'm trying to say? Where it can really boost your account. So yeah, if you do feel like you're in this and you're positioned well, do consider potentially doing that, but just don't do it all the time. Don't be swinging for the fences when the technicals do not justify it. So anyway, we have a bearish IBOS. We now have another clear M15 supply zone, right? Whether you want to refine it to the pivot or the larger buy to sell, that is up to you. So now we can look to see if we get that fake break going once we have our mitigation, right? So we pull back in, we get our mitigation, no strong liquidation yet. This high here has not broken any structure, so that will not be a strong liquidation if that high goes. Okay, we need a high that breaks a low. Okay, we coming in. Okay, now we get a bearish M5 change of character. Okay, this high breaks the low. So now potentially we can get a fake break. Where's our, there we go. Cool, so set your alert on there. Maybe we'll pull back, maybe it won't. Okay, ding, 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 alert goes off. We have our strong liquidation. I'm just gonna rein this in for a minute. Obviously this trade is still running depending on how wide your stop loss was. Otherwise, you might be out if it's a bit tighter. So now we have our liquidation, really nice corrective pullback, really high probable trade because of the higher time frames, not because of the entry model, right? It's the higher time frames, the medium time frame that makes a trade probability high or not, in my opinion. So yeah, pip or two, whatever. Well, again, I'll talk about how to be a bit more scientific with this later, and I'll keep repeating myself, but we will get into that. Okay, and let's just say, we do another target, but you're well within your rights if you want to target further with these trades. So we either get tagged in, or if it pushes up higher, we will cancel the order. Okay, we're tagged in, really good start to the trade. But yeah, with this management, I'm not trading to break even, we just settle forget. And there we go. So yeah, in my opinion, two what I deem to be pretty damn high probable trades. Like it's aligned with the 4-hour chart, obviously aligned with M15. We've pulled back up, we've liquidated this high, we've had the PBL firm flip. There's an initial trade within there. POI selection is a little bit, it's not the cleanest of POIs, but this one, if you were and ahhing about the first one, this one, no one should be missing this trade. Once you understand all of our rules, these are trades that we've got to be capitalizing on. Like put your foot on the gas, do not be afraid of taking a loss here. This is go time, as I keep saying. And then yeah, whether you want to just be religious with the fixed hour targets is up to you. But when we have this environment, like on the 4-hour chart, it's not something I'm very good at. I'm terrible at holding trades. My personality is to just be in and out. But these are the environments I try to remind myself of every year. When this happens, don't be afraid to give a bit of profits, back on the table if it ends up doing this or something, whatever. But these can be the ones where suddenly when it goes, there's nothing here and it just ends up absolutely tanking. But yeah, you don't want to be swinging for the fences with every trade. Yeah, as we can see, we end up getting a pretty big bearish move. So what I'm actually going to do is just bring this to the next session, because it's kind of just an interesting scenario to talk about before we wrap it up and dive into the statistics. So just bring this around here. So if we kind of follow this on, super quickly drawing some structure, we obviously had another M15 boss. And after a boss, we can expect a pullback. But when momentum is strong, when I keep saying on the higher time frames, there's nothing really to support price, the odds of us now getting a very deep pullback are slim. So this is when, if we go back to the phases, and let's have the bearish scenario. This is when phase A2, right? So when we're like trading, down here, whoops, we've had a bit of an internal pullback and maybe there's some supply here. You can view this as like phase A2, right after the boss. This is when this can be on that higher end of the medium probability. Maybe some of you want to say it's high probability. I struggle to call A2 ever, super high probability just because you're not selling in a very well priced area, right? I'm always expecting that deeper pullback. But for me, it's on the higher end of medium probability. So I very rarely really want to trade A2. But this would be the sort of scenario where I'm like, yeah, no, do you know what? I don't care if we have a deeper pullback. I'm willing to be a bit more aggressive here and get involved, right? So we've got this M15 supply range to the left. Okay, nice corrective pullback overall. How do we know markets move? It's kind of what you learn day one on baby pips. Impulse, correction, impulse. It's just to find that we could likely see another leg from here. If we push up higher, so be it. But I'm willing to look to get involved, right? So we're already kind of within the supply range. It's up to you if you want to be over refined or not. So let's jump down. What time is it? It's okay. Frankfurt's open, so we have our session open. So I've actually jumped the gun a little bit here because if you take the supply range rather than the pivot, we do already have our mitigation, and we have this high here that has not been swept yet, right? That obviously broke some lows and we've got some nice equal highs to back it up. But yeah, we're not just trading equal highs on its own. It needs to be a fake break, okay, with this new entry model refinement. So here we go, just in the interest of not being lazy and drawing out, that high obviously clearly breaks structure. So this is where we would set our alerts on there and wait for a liquidation. Okay, boom, alert goes off, liquidation. We've obviously had the POI mitigation. If you want to get involved, technically this is the start of your first, time where you can set a sell stop order to potentially get tagged in. Now, if you want to get that kind of 3.3R to the low, it's up to you whether or not you view the risk to reward as there. I would say most times price is probably going to push a little bit past the low anyway, so don't be too afraid of if your exact target can't get below it. See how you get on with your testing. But obviously in this scenario as well, what are we expecting? We're expecting a lot further downside. So this is where you're like happy to have kind of, not getting a full target before the low anyway. So let's take a look and say if you did it this way, right, you don't need to stop to be here, give it a bit of room. Again, we'll talk about how you can make that exactly mechanical, so you're not using too much discretion on the buffer you want to use. So this is a good example, right? Because we have our sell stop below the entry candle, the liquidation candle. I don't know what we're going to call it yet, but whatever. We get the next candle. Now this candle doesn't break the high, so we don't need to cancel it, but we also don't get tagged in. So when that happens, you just leave the order. Nothing needs to change, okay? Next candle, okay, that tags us in, so now we're in the trade. Let's see what happens next. And then we push up. Now, depending on how tight your stop loss was, you may have been stopped out. So yeah, let's just say we got stopped out, okay? We take a loss, no problem, right? I think that's a decent area that's worth getting stopped out on. You take the loss, lick your wounds, it is what it is. Now, this is key, right? Don't just get annoyed and don't look at price action. As long as you haven't hit your risk limits for the day, whatever you set those in your trade plan, just save this down for later, journal it later, take your screenshots, do what you need to do, but be on the ball. What do we have? We have an M5 change of character here. It's a bit subtle, but let me just double check that. 370, and the low of that is 369. So it's about 0.1 pips, so a little bit harder to see, but it is there. And now we have another strong liquidation of this high. So now we can enter on this candle here. So again, depends on what buffers you use, right? And then here we go. Exact same idea. 2 inside bars, so nothing to do. Didn't push up, so we can leave the order on. Let's see what happens next. We come down, and then we get tagged into the trade. See how it goes, and there we go. Start to push down, come back up again, and let's just hold it down, speed this up. Pretty slow, but then eventually we go, okay? And it would have hit your target if you've got that 3 target there, okay? So if you had a bit of a wider stop loss, you probably would have been able to ride out that first initial trade. If you got choked out, not to worry, try and be on the ball and see if we've got another one there. There's your liquidation, few inside bars. We eventually got tagged in around 750. And there we go. So yeah, typically I'm not a big fan of the A2 trades, and I would advise literally just don't trade them until you are consistent. Try and be disciplined or not. But if we get in an environment like this is kind of when I'm a bit more willing personally to look to trade those. So yeah, I hope that kind of series of breaking them down into low, medium, and high probability was helpful rather than kind of just doing random examples. It's really good to kind of reiterate this theory with the phases cheat sheet. It's not completely foolproof, because obviously every scenario is quite different. There's always variables you need to take into account. And like I said, that is probably the hardest part of the strategy, is getting the experience to know what to pay attention to when, to weigh them all up in your mind and when to get involved. But I promise you it does come with time, and this cheat sheet hopefully can be extremely helpful of a way to think about it. And obviously also what will be helpful is when you do your data collection through your backtesting and also your live trading, is to have a column in your spreadsheet or Notion, whatever you use, and to label these categories. And you may want to build your own categories. You may want to make even more categories there with more filters, whatever. And it will just really help you to zoom out in the long run and see what stats work for you. And that is how you build your own trade plan. That is how you build your own confidence. And that is ultimately how you become an independent and consistently profitable trader, right? It's not like a cliche little phrase we throw out there. That is our ultimate goal with Photon, with you guys. We want to show you the way that we do our things. We want to teach you with the way that we think is most effective, but ultimately you will get that long-term consistency when you grab the stuff that we give you that you resonate with, you disregard and get rid of the stuff that you don't really agree with or doesn't work with your personality, and eventually over time you will mold something that will work for you. But to be fair, it's a never-ending process. We're doing it ourselves. We're bringing you on that journey, and this new module is a perfect example of that. So before I keep rambling, let's dive into the following lessons, which I believe probably will be the statistics.